schedule. We had some important matters in the loan committee. Took a little while longer than what we had scheduled, and that's, I apologize for that. So let's call the meeting to order. Please, everyone remember that we are now on the videotape, and begin with the roll call.
Carl England.
Here.
Mark Noney.
Here.
Jack Prothero.
Here.
Terry Cody.
Here.
Bruce Nelson. Here. Diane Fladmo.
Here.
Maggie Peterson.
Here.
Jeff Greenfield.
Here.
Jim Edwards.
Here.
Senator Sales. And Representative Hamilton.
Here. Well, welcome everybody. Welcome Representative Hamilton. It's nice to, I hope we provide a little respite from the...
Very nice not to be in the Capitol.
You didn't have to say that on tape, but
I don't mind being quoted. Everyone will understand.
All right. Are there any public comments of issues within the board's jurisdiction?
We have two.
Okay.
So I'm going to let Alfredo go first.
Okay.
All right. My name is Alfredo Mendez. I'm a banquet server at the Irvine Marriott. I've been working there for almost 7 years. Last year, I joined the union organizing committee. I decided to fight for a union because there's no transparency with our tips and managers are abusive. I felt the company has been keeping a lot of our tips and there's no way to know if the tips we get from an event is the correct amount. Instead of one job that pays me fairly, I have 3 jobs so I can pay my bills. I only had 2 years left to graduate with my degree, but I had to drop out of college because I just couldn't afford it anymore. When we demanded a democratic union election, CBRE and their operator could have agreed, but instead they fought hard to keep us quiet. The company ran a strong and nasty anti-union campaign. They brought in more than half a dozen people from corporate, including David Marriott himself. It created a lot of confusion and fear amongst my coworkers. Luckily, both of my parents are union members at different hotels. I've known since an early age how important it is to have job security with good benefits. This gave me the confidence to organize the union and speak with my coworkers when they were scared. The day of the union vote, management hired a lot of security guards. It felt like a police zone. Our election was definitely not democratic, but we won by more than 2-1. Now we are fighting for a fair contract. Unfortunately, I have not seen CBRE or its operator change their attitude. We have not seen the company do anything yet to address sexual assault and harassment complaints filed by my coworkers. We're going to keep fighting until that happens, even if it affects the hotel's bottom line. On February 15th, we had a press conference and a picket line at the hotel to demand a fair contract with protections against sexual harassment. You met workers from the Pullman Hotel, which is also owned by CBRE. I don't think Pullman workers should have to go through the same aggressive anti-union campaign that we went through. CBRE needs to get its operator at Pullman to agree to labor peace. My coworkers and I are determined. We know who we are up against. We know CBRE owns the hotel. We know CBRE calls the shots. My coworkers and I are prepared to fight as long as it takes to get CBRE to listen. I don't know how this dispute is good for anyone. It's not good for me. It's not good for my coworkers. It's not good for investors either. Why would you want to keep giving money to a hotel that's being sued for not protecting its employees from sexual harassment and has let things get this far out of hand? Is this the sort of business partner you trust to make smart decisions? I'm here because I know that CBRE will listen to you. If you tell them that you are concerned about your investments, they'll listen because they want more of your money. Thank you.
Thank you. So good morning. My name is Laurel Fish with Unite Here. I'm here with Jordan Fine from Local 11 in Los Angeles and Mark Anderlich from Missoula. I know we've been here several times before and the board is now very familiar with the growing labor disputes at CBRE-owned hotels. Before I started, I just wanted to be clear about a couple things. We are not asking the board to divest from current investments. And we understand that the board does not vote on individual investment managers. We're clear on that. However, what we're asking you to do is proper due diligence before committing to future investments. We believe that you can still take action in the best interest of the fund. And I think there have been a couple key takeaways over the last couple months. First, CBRE is the common actor between the Irvine Marriott and the Pullman San Francisco Bay hotels. At both hotels, they've allowed their chosen operators to mismanage labor relations. And CBRE can resolve these disputes. That's fully in their power. Second, actions by CBRE's hotel management have created bad headlines and led to picket lines at both hotels that should be of a concern for investors like Montana. Third, there are significant inconsistencies between what CBRE has told limited partners and what has actually happened. For example, CBRE told staff of a key limited partner that it would be neutral, but then allowed its hotel management to engage in an aggressive anti-union campaign that you heard about from Alfredo. On December 12, 2018, the day before the Irvine Marriott workers petitioned the National Labor Relations Board for a union election, a trustee of this other limited partner informed the union that CBRE Global Investors had ensured the limited partner staff that it always remained neutral during NLRB supervised union elections. In fact, CBRE Global Investors management at the Irvine Marriott was never neutral, as you heard. Since we were last here, you should also know that a regional office of the NLRB did an independent investigation and found merit with multiple unfair labor practice charges filed in the weeks before the election. The NLRB regional office is continuing to investigate additional charges. The unfair labor practice charges allege that managers illegally interrogated, threatened, and retaliated against workers. Before the election, the union asked CBRE Global Investors to send a letter to its operator directing managers to be neutral. To our knowledge, CBRE never sent that letter. And these are not the first inconsistencies between what CBRE is telling investors and what's actually happening. The Montana Board of Investment staff has also informed me that CBRE Global Investors told them the union was demanding agreements at 2 hotels from its operator, the Pullman Hotel, that's the one in the Bay Area. And that this was the principal reason their operator, a company called HEI, was unwilling to settle the labor dispute at the Pullman. That's not true. In fact, Unite Here Local 2 never demanded agreements on 2 hotels. Local 2 President Anand Singh, who was the key negotiator with CBRE Global Investors, made this clear when he testified at a key limited partner back in July 20th of last year. It is also still true that CBRE has been unable to sell the Pullman Hotel. Even though the hotel has been on the market for sale, the Pullman's general manager announced to employees in late January that the hotel was no longer for sale. To date, no further statements about the status of the hotel's sale have been made to employees. CBRE Global Investors has also not sold the Irvine Marriott. You should be aware that CBRE Global Investors will likely soon begin fundraising for CBRE Strategic Partners US Value Fund 9. If I was in your shoes, I believe that the board should ask several questions of CBRE before moving forward with future investments. First, why was the Pullman taken off the market? What are the current obstacles to settling the dispute at the Pullman? And is the operator HEI a significant obstacle? Second, how does CBRE Global Investors explain inconsistencies in its accounts of these disputes? For example, why did CBRE say that it always remains neutral and allow its operator at the Irvine Marriott to do the opposite? Third, CBRE Global Investors competitors, Blackstone, Brookfield, CMI, and Rockpoint, have found ways to invest in hospitality while providing their investors with a guarantee of labor peace that protects investors from labor disputes. Why can't CBRE Global Investors do the same? And lastly, has CBRE Global Investors approached the board about investing in Fund 9? Given the issues described above and the sexual harassment lawsuit at the Irvine Marriott, will the board direct staff to ensure that there's a public discussion of the issues that we've raised? So we'll be here for questions, and we look forward to continuing to work with the board to find a resolution to these disputes that helps ensure retirement security for fund beneficiaries. Thank you.
Any other comments?
There are comments, questions?
Any additional public comment?
Thank you.
If not, Terry, did you want to yeah, we do it during the public comment period?
I just wanted to recognize the loss of Gail Moon, who was with us for so many years as our chief accountant. She just was an amazing human being, and it's so sad to me that she had so few years in retirement after she left. So I just wanted the meeting not to go by without us recognizing that Gail is no longer with us, but she gave so much to us.
Thank you. And then I'll take an opportunity in the public comment to thank Senator Brown and the Senate Administration Committee that heard our nominations yesterday, and everyone who could be there was there. We were treated very, very well, and I guess I look forward to a smooth confirmation process. Anyway, so with that, we've got some minutes of the February 12th and 13th meeting. Has everyone had a chance to review them? Are there any corrections or additions? If not, is there a motion to approve? So moved. Second?
I'll second.
Any further discussion? Not, all in favor say aye.
Aye.
Any opposed? None. Administrative Business Audit Committee.
I think everyone was there, so I'll just be very quick. We do need a decision on item number 3, the investment consultant RFP draft. Just to refresh, the plan here is that the staff would review the responses to the RFP. The ad hoc committee of 3 members would go over that scoring with the staff afterwards. The full board would then, at the November 19th, 20th meeting, interview the finalists and would at that point make a decision. Our current contract goes through November 31st of this year. So that's the reason for that timeline. The only thing to know about the RFP in front of us is there's a little issue about scoring between PERS and our organization. That will be resolved shortly. What we're asking for is approval of this RFP so it can move forward today. And I would so move.
Okay. Second?
Second.
Any further discussion? Yes.
I have Commissioner Director Edwards, and who are the other 2 ad hoc committees?
Yeah, I was going to do that once we approve the
Okay.
Peterson.
Right. So don't get ahead of me. Keep me in line, but don't get ahead of me. Anyway, is there any further discussion on the motion? If not, all in favor say aye.
Aye.
Any opposed? None. And the committee is Maggie Peterson, Jim Edwards, and Terry Cohey, who were the ones who volunteered. Now's your chance for anyone else. And I think, like with all committees, the chair will participate as a non-voting member, but we'll just call it that. Is there another decision? Is there any other?
Just the checklist, everybody has the changes on that. You can see on the internal control policy, we need to vote on that. And really the meat of that matter is now that we have a fully operational investment operations and risk management team, this just clarifies who's responsible for what and provides backup. I would so move that changes adopting the revised policy.
Okay.
I would second that.
All right. Any further discussion from anyone?
Oh, I do have to point out something very important, and the coffee fund is in this too.
Right.
And they'll drink more.
Okay, any further discussion? If not, all in favor of making the changes to the internal control policy as provided for behind tab audit committee? All in favor say aye. Aye. Any opposed? None. Okay, anything else from the audit committee?
No.
Okay. HR?
I think the full board was there and we had great discussions, but no decisions were made for this meeting. Hopefully, the next meeting will be much more exciting.
Okay, loan committee, Jack?
Loan committee met, we had a couple loans that the loan committee approved. One was to the Department of Natural Resources and Conservation. That was a $3.4 million loan for their drinking water state revolving fund. The second loan we approved was to Department of Natural Resources and Conservation, $4 million interim loan to its water pollution control revolving fund. It's an ongoing relationship that we have with DNRC, and both have been very successful in the past. We also met to approve a couple loans. One big loan has to come before the full board, and Doug will present on that, but the loan committee did approve a loan to My Storage LLC in Bozeman, Montana. The Board of Investments, part of the new loan to build some storage units was $484,000. But we have prior additional relationships with that borrower that total approximately $1,558,000. So that's why that had to come to the loan committee, and the loan committee did approve that. And so the one loan that we need to have full board approval on is a request from Neptune Aviation in Missoula. And Doug, if you would come up, and Doug will give us a short history. We do take a lot of time. Carl was generous in saying that he apologized for loan committee being over, but loan committee does take these things seriously. We had a lot of questions because of the loan size, and so we have looked at those. So I don't want people in the public to think that we just do this without careful consideration. But for the record and for any additional questions, our staff member here, Doug, will present this loan request.
Great, Doug?
Good afternoon, Mr. Chairman, members of the board. We did have a robust discussion regarding this loan request. I'd like to just mention to everybody that is here that isn't aware, we have two members from Neptune Aviation here, Jennifer Grahn and Dan Snyder is here from Neptune Aviation, and from Bank of Montana, we have Jake Pelzar and Danny Day are also here, and they were able to answer questions that the board had, and I really appreciate you guys coming and partaking in part of the loan request. What was presented today was a request for $10 million, of which the Bank of Montana would have 20% of the loan, or $2 million, and the Board of Investments would have an 80% participation, or $8 million. The purpose was to provide long-term financing for the purchase of 2 new aircraft, which will be used for firefighting, and then the construction of their new hangar facility located at the Missoula County Airport. Neptune has had previous loans with the Board of Investments. All have been paid as agreed. They have excellent management staff. I think all of our questions, I believe, have been answered at loan committee, but if there are any additional questions, I would be happy to answer those questions at this time.
Okay. I think it's nice to recognize the applicants are here, and if you have anything to add.
I would just like to thank you for taking the time to meet with us and the opportunity to entertain our loan. Thank you.
Okay, any follow-up questions? As I said, that this is what kept us from starting our meeting on time, so this has been discussed fairly thoroughly, but any other questions from anyone?
If not, Mr. Chairman, I make a recommendation based on loan committee information, that the full board approved the loan to Neptune Aviation Services, Inc. in the amount of $8 million.
Is there a second?
I would second.
Okay. Any further discussion? I want the record to show that I'm going to recuse myself from voting on this because I represented Montana, or the Bank of Montana. And with that, unless there's anything else, all in favor say aye.
Aye.
Any opposed? None. Passes. So thank you all for coming and for the loan. Anything else from the loan committee?
That's the completion of the loan committee report.
Okay. Anything from our TRS and PERS board members? Maggie?
I've got an update for you. At PERS, we had an internal auditor, Gene Megan, and he took a position for another state agency, but before he did, he gave us the results of some audits he performed out in different entities, such as school districts, county offices, that type of thing. Anyhow, he performed 26 of them. It's interesting to see that there were 12 of those employers had no findings. There were 10 employees who had 1 finding, 3 employees who had 2 findings, and 1 employee who had 3 findings. And what that means is there were different things where they might have, I'll give you examples, the hours weren't coded properly, part-time employees weren't given the opportunity to participate. So anyhow, they went through and identified these different areas or issues, and we got them all corrected. If we hadn't corrected them, there could potentially be issues down the road with people saying, oh, gee, I want to opt in now. You'd have to go back and figure out how much the employer owes on their behalf, and it could impact the liability of the pension plan. So this has been a really good thing to have an auditor on staff, and hopefully we'll replace that position soon. We did make an appointment to the EAC, or Employee Incentive Advisory Board, of an individual by the name of Kim Stout. She's the president of the Helena Education Association. That's a good addition. We updated a couple of investment policy statements. It's kind of interesting. We had language in there that said that employees, individuals, it said the selection is intended to make it possible for the individual participant to achieve a balanced portfolio consistent with modern portfolio theory. What does that mean? So we got rid of that last language that said achieve a balance and inserted materially affect both the potential return and the degree of risk in each participant's account. And this is for the 457 plan and the DC plan. Those are pretty minor changes, but kind of clarifies things. We also extended the Sagitech support contract for our ERIC reporting system. People keep asking on my board and probably throughout the state, is this ever going to come to fruition and fully functional? The answer is yes. But it's another $1 million, $908,000 that we're putting towards this extension. And Sagitech has agreed to give us some additional free support. So hopefully this reporting system will be totally up and functioning by the end of next February. I also have something that I'm going to give to all the board members. It's really a fiscal year 2018 highlight on the defined benefit and defined contribution plan and the 457, and I think it's just additional good information, so I will have some copies made and distributed to the board.
Okay,
That's
thanks.
my report, thank you.
All right, any questions? Yes, sir.
So,
Yes.
maybe that audit, I assume it wasn't an audit of every participant, correct? It was just a selective,
Generally, it's a
I mean, a random sort of...
random, but what'll
So-
happen is if he found an error, then he might extend it to, like if it's a small
System-wide
county.
correction of the error, or is just in the files that were, I mean, my question is, you found a lot of findings, I mean, there are a lot of findings. So, how do you address that with regard to the whole population of members? If there are that many, if that's a sample of the many findings that are found in all of the...
We actually have a schedule where he will hit all employers, or he won't, but our auditor will hit all employers over a certain period of time.
Oh,
And
eventually?
and they do a sample, as you said, but if he finds some major findings, which I think there were probably 3 in my mind, inaccurate census data, people not being allowed, given the option to participate, and there was an outstanding invoice that we got paid. But those types of things, if it's important, he would extend it to a longer
Since to what?
extend it to a larger group of employees. And if you see a real problem, they could check all employees. There are some of these county offices that are very, very small, school districts that are very small.
Okay, thanks.
I just have one comment there too. Over the weekend, Maggie, I had a conversation with a field rep in the Whitefish area where there's an individual who's ready to retire, classroom aide, who is still a PERS instead of TRS. Yeah, so there's another one of those out there.
We actually found one of those on this
Yeah,
review too, and they're finding that they're in the wrong
yeah.
retirement.
You know, just for other information, years ago, any person who was in a support position, they were in PERS, but then if you were actually a teaching aide in the classroom, you had the choice and you could choose which system to be in. And then in the early 2000s, that was changed to where there was no choice. All of them would be transitioned into the teacher's retirement system, and a number of people we found have kind of fallen through the cracks on that.
Well, it's a transition.
Yeah, so there's no choice anymore, and those employers are supposed to report them to the appropriate system, and that just sometimes isn't happening, and there's really some costs involved in that, and an actual change in the retirement benefits of those individuals, and sometimes it's a very negative change when it's not caught. So those issues are big. The auditor thing is a really big deal. I think both systems, it would be great if we could maybe combine that and have more going on. That's
That'd be a
another
great
issue.
conversation to have with the two systems to see if they could do more review of that type of.
It would. And I think most of our issue of not hiring one has been space available, which will certainly be part of my report.
Okay, well, let's have it right now.
Right, so last time we talked a little bit about TRS running out of space, looking for leases. There has been a lease signed with Board of Investments on Park Avenue building. Essentially, most of the first floor of Park Avenue we will be, we've leased, long-term lease. The contract's going out right now for some updating and remodeling. We should be moving in the 1st of July, is my understanding at this point. Towards those same ends, even though it's TRS funds, we had to have a bill into the legislature to approve the use of those funds to remodel the building we're currently in and own. Yeah, kind of silly, but that is the way government works. Just saying. And so that really hasn't finished yet, but that's out there likely to be approved. How much remodeling takes place just depends on what entity is likely to lease our building. Since it is in kind of the government campus, likely it would be another agency of the government moving forward. We'll see. Our last meeting as well, Joe Cullen was there to present the annual report, and thank you for being there. Good update. Everybody always learns a lot. It's good to see you there. And we too have been going through changes for the last 3 years on our software system. Those have been going very well. We're into the final stages of add-ons, really, so we're getting a lot of ability to do online forms, which has worked out quite well. It's nice to see you can go into your website, sign into your particular account, and you can make adjustments that you need to make. Beneficiary, anything that takes place, we're able to do that. There are some learning videos and tools that are going in there, so people early on, instead of not knowing anything, and the generation we're in can click on some of these videos and see what retirement really is about. And maybe this isn't the only leg of the stool they need for retirement, and hopefully push some people into some other things. But it's going very well. Should be done by November, which is outstanding. Very costly, but great.
Okay, anything else?
That is it.
All right, any questions?
I just wanted to make sure that everybody understands that when they say if they're Park Avenue, they're going to be in the same building with PER. Yeah.
Right. Yeah, different floor, a little more collaboration potentially. Be a good thing.
Representative Hamilton, anything going on over there?
I'm not really. That silliness part that Jeff talked about, maybe a little bit of that going on.
I'm shocked and amazed.
I would mention three things real quickly. Number one, last week was the deadline, or actually Monday was the deadline yesterday, April Fool's Day, for transmittal of all bills from one house to the other house, which theoretically means that there is no bill out there that isn't alive, that can be alive, but I say theoretically because nothing's ever dead or gone or impossible apparently at the State House. So, but generally, all bills have been transmitted to the other house, and that'll be the activity now for the next 23 days of the session, if it lasts that long. One of the big things coming up here shortly, which just has an impact on state government in general, not necessarily this organization, but is the revenue estimate will be set or changed if it needs to be changed from what it was set in the fall, and that will be set here in the next probably 10 days, maybe even less, maybe the next week. Third thing I can think of to mention, and maybe Dan has some better awareness of other bills, but there's one bill that has a direct impact on the Board of Investments, and that is House Bill 476, which was introduced by Jimmy Keene out of Butte. And the idea of this bill is to give the owner who, or the purchaser, let's call it that, of a coal-fired generating plant the opportunity to tap into $50 million worth of money per year, is the way the bill reads. And I would assume that's either from the infrastructure fund or the intercap fund. It's really kind of not clear. In the bill, we tried to wade through it. I think the limits of those two funds are 70 million and 80 million, so there's a little inconsistency here. But I guess we'll see if that gets figured out here in the next 3 weeks. That bill is right now been all the way through the House, heard and voted off second reading in the Senate, so it's now scheduled for third reading and would be, I assume that happens today or maybe tomorrow. So it appears from the outside as though that has the opportunity for the company who might be accessing that loan to sort of drown out the other opportunities for some of the things that you've heard today on loans. So something to keep an eye on.
Okay.
That's it. Unless Dan has some other legislation that might be significant.
Not really. I mean, that one is one we've been tracking. 276 by Representative Grubbs affecting the intercap program has been signed into law. And then our FTE bill, the hearing has been rescheduled for tomorrow in front of again Senator Brown's committee. So that's hopefully you guys all get home in time to plant some flowers.
Okay. All right. Anything else?
That'll do it.
Well,
Thank
we know the demands on your time. It's nice to see you. So thank you for coming.
Fun to be.
So Bruce and Jim, you had an opportunity to go to out to RBK, and you want to? Is there anything to report other than that you learned a heck of a lot? And
I learned a heck of a lot. Jim and I had a really good
We
talk.
only had a day with them, so we didn't have enough time to really get them straightened out.
oh, is that right?
I thought they got me straightened out a little bit, but
No, it was.
it will take more time.
Okay, all right.
Yeah, for sure.
Okay. All right. Thank you. Dan.
Mr. Chairman, board members, tab 2, you have my report. We didn't have any follow-up from the last meeting. You have the monthly snapshot included. You also have a memorandum per the work plan on our custodial banking relationship at State Street. Happy to answer any questions you may have on that. Also per the work plan, this would be the month that we would revisit the website. However, given that we've done so much work on it over the last several years, what I'm going to start including is the monthly utilization statistics for you, so you can see where people are going, what they're looking at, and then a standing request of any board member you see things on the website that could be more clear or ideas for improvement, we are always happy to hear those. Other than that, Mr. Chairman, that is my report. Happy to answer any questions.
Any questions? Okay, so we're 25 minutes behind schedule. Why don't we reconvene at 12:45? Does that work for you?
Yeah, absolutely.
We may, some of us may still be like eating, is that?
No problem. And we probably won't take the 90 minutes, I'm guessing, so we may give you a little time back.
Yeah. And we can, what's that?
It'll take 15 of their time.
Do you, yeah, is that, you're
That's
not,
totally fine.
all right. Well, okay. So why don't we reconvene then at 1 for your presentation? Does that work for you?
Yes.
Okay. All right, with that, we'll. And, next item is capital market assumptions and asset allocation.
Great,
So welcome.
thank you. Becky Ratzinger and Mike Taub from RDK. It's great to be with you.
Becky, have you met all the new?
I have.
Oh, okay.
Had the chance to spend time.
Oh, that's right, they
Portland,
came.
so yeah.
They came to
Been
Portland.
very spoiled.
Yeah.
But no, I have had a chance to, and this is going to be a great conversation today. This is something we like to do every year, to talk with you about the markets as we look 10 to 20 years into the future. We update that view every year. So we would like to brush off what we think your expected return and characteristics look like once a year. We'll tell you about how we set up our capital markets assumptions. It was a particularly interesting year to do that, given what's happened with the yield curve, what's happened with equity markets, especially as we finish the end of last calendar year in a bit of a turmoil when it came to the equity market. So there were a lot of discussions, and we'll give you a flavor for that. We're going to tell you that your portfolio appears quite efficient. You have a very good expected return and risk trade-off characteristic in the portfolio right now where it currently sits. And we think there's some good ideas to consider going forward. One of the things that you'll find is that we don't temper our recommendations by what worked well yesterday or in the last 10 years, but try to always look forward, because that really is the challenge for you. So we'll take you through that process, but I thought since we just finished a quarter, it would be interesting to just acclimate you to what's been going on in the capital markets quickly, and then we'll move into our presentation. So if you want to go ahead and turn to page 3 to get, or page 4 actually, to get ready for our conversations. You've all heard about the yield curve. Mike can talk a little bit more about this a little bit later in our presentation if we have enough time, but certainly the markets have given us some indications and concerns about whether there's a recession coming or not by the yield curve becoming inverted. And when we ended the quarter, we actually did see some positive slopes between the 1-year Treasury and the 30-year Treasury. It's pretty narrow at about 41 basis points today, but certainly it is a pretty flat yield curve environment. Inflation doesn't seem to be a big issue. We'll talk about that as we worked our capital market assumptions. And wow, if you've had the chance to keep up with what's been happening in the equity markets in 2019 after the whiplash we got at the end of last year, on a calendar year-to-date basis through the first quarter, the S&P 500 is up 13.7%. Amazing. So a lot of recovery there. The emerging markets are up 10, EFA's up 10, the small cap markets in the US are up about 14.6, the high yield markets are up 7, and as we look at the bond market, up about 3%. So 2019 is off to a very good start after a rocky fourth quarter in last calendar year. So that just gives you a flavor for the markets being a little bit more constructive in the current year. But while we were making our capital market assumptions, things were still very much uncertain. If you look at this first page in our presentation, we want to put into context where the asset allocation discussion takes place. There are some decisions that this board makes at every meeting that are very important. There are some longer-term decisions this board makes that actually have the most impact on your investment results over time.
And one of the first ones is to the left on this chart, and that is to just have an awareness of what's going on in the liability side of the equation. Because we talk about assets here, and the system representatives are used to also looking at the liability picture for PRS and TRS. But actually having a formal study putting those two worlds together is something that fiduciaries should consider every few years, especially if there's a change, a significant change in the liability side of any plan. Basically, those particular studies give trustees an idea of what kind of risks they can take in a plan. And that feeds into the next step, which is an asset allocation study. Once you know what the plan needs and what kind of risk you can take, then you can actually select among the menu of fixed income, real assets, or other diversifiers, and decide what asset classes you want to participate in, and then how to structure them in your portfolio, what proportions of them should be in your portfolio to meet your needs. To the right-hand side is making finer-tuned decisions about whether you should be in certain types of alternative strategies that break out sub-strategies. For example, in real assets, what kind of real assets are you going to own? Are you going to be in public or private? What categories? In equities, it may be how much you have in international versus U.S. equity. And then farther on the right-hand side is things like active passive decisions, how much to have in indexing versus active management, and then which active managers to select. So a lot of times when we meet each quarter, you particularly structure your agenda in a way we think is very helpful because it focuses your attention away from the right-hand side of the chart that has much less impact and more towards the total portfolio conversations, which is where you're really going to be most impactful as fiduciaries. So I wanted to start with that perspective and then moving to the next page, page 5. You've seen these statistics in any number of studies. Sometimes the numbers change a little bit, but really your asset allocation decision will drive the returns that you have over time, 100% of the time, and 90% of the risk that your portfolio has. So these are very important decisions that you make and very, very important points of due diligence as you review your structure as we are today. And it does make a difference. All the time your staff spends and the time that we assist them and the reports that you hear at board meetings, manager selection does matter, just not as much. And that makes all the sense in the world. How much you decide to have in the equity market is much more important than what large cap value manager you pick at the end of the day. Mike's going to take us through a couple of examples of things that may not be as intuitive as you're an institutional fiduciary looking at an asset allocation decision. So we'll go ahead and point you to page 6.
Yeah, so as Becky suggested, the next couple of slides are just some examples to kind of tie in the underlying process that we're going through, how risk plays into this, portfolio risk, how expected return plays into this, and kind of showing some graphics of what that means. So on slide 6, and I apologize in advance, some of these are kind of in the weeds a bit, but I'll try to keep it pretty high. If you look at the 3 portfolios on the left side, portfolio 1, 2, and 3, they all have the same average return over the 20-year period, okay? Portfolio 1's a really easy one to look at. Every return for the 20 years is 5%. Okay. Now, very unlikely, but for this example, this is kind of how we draw through this. Now, if you look at portfolio 2, again, it's the same average return over the 20-year period, but you go from 0% one year to 10% in the other, right? That volatility, or what we kind of call risk, standard deviation, is going to impact your long-run portfolio. And then if you go all the way to portfolio 3, you can see that actually you have a negative year followed by a positive year, and then a negative year and a positive year. Again, you can see in the bottom of the table the average is 5%. What those 3 portfolios have are different standard deviations, which is just underneath those average numbers. So the first portfolio, because there's no variability, the standard deviation is 0. There's no difference from month to month or from year to year. Portfolio 2 has a little bit more variability, so you have a little bit more volatility, a little higher standard deviation. And then portfolio 3 jumps up quite a bit to 10.3%, so there's a lot of volatility in comparison.
How do you, the 0 to 10, 5.1%, the standard deviation?
Sorry, do that, so one more time?
Well, portfolio 2
Yeah.
has 0 to 10%,
Returns, yes.
right? And the standard deviation is 5.1%.
Right.
So what is that?
So the
And
standard-
every time you go through this, I ask the same
It's
question.
fine. It's a great question.
And I
So what
never
we're
remember
doing
the answer.
is it's a statistical measure, it's looking at the average, and then it's looking at the deviation from that average over time.
So it's the distance of the observations to
Yes.
the average, mathematically. And in investing, what it isn't is showing you the chance of losing money. It's actually when your returns surprise you above your average and when they surprise you on the downside. And that's one of the items in modeling that I'll talk about in a little bit more detail. But in investing, if you can choose between portfolios that have the same return, but one of them has less risk, in a lot of cases over time, it's going to impact the right-hand side of this chart, which is where Mike is going to head next.
Yep.
Does that help, Carl?
Yes.
It will absorb it. It will absorb it. The more we have
Is
this-
there a quiz? Let me ask that.
Well, I'll be emailing you, twittering out a.
But as Becky just said, if you look at the right chart, it's the best visualization of it. And that, quite simply, is, if you look at portfolio 1, which is the green line, over the 20-year period, that compound return, which is your realized return, is 5%. Anything else with some degree of risk is going to have a lower compound return. The other way to think of it is, if if the portfolio declines 50%, you've got to make that back up.
Right.
Right? And it's not, if you go from 100 to 50, that's a 50% drop, but 50 back to 100 is 100%.
Right.
So, the simple answer is when you have, more risk in the portfolio, it's going to impact your long-term returns.
It will erode wealth.
Yes.
And so that becomes one of the things we have to plan around, is how to control volatility.
Okay. I remember when, so I remember in engineering, there's a way to calculate standard deviation.
Yes.
And my recollection is that it measures like the distance over time that the line varies from an average.
Exactly.
Very
So
good.
that's kind of a statistical
Very
thing.
good.
Yes.
And so I think that might be lost sometimes when you start talking about what it means in terms of financial terms as opposed to guys like me who are used to data terms. So,
And it's the same calculation. I think where it gets a little bit muddier is in the investment world, we use that standard deviation calculation as a proxy for risk.
yeah.
And yet there are a lot of kinds of investment risk. And for most individual investors, we fear losing money more than we fear or are concerned about positive returns. So behavioral finance is a whole study of how we react to these issues. But in the investing world, in our conversation today, we're going to use standard deviation and risk interchangeably, but it is that very calculation you cited.
If we turn to slide 7. So this is also a critical component of portfolio management. And we've talked about this over time, but it's always good to review. And that is the correlation between the assets that are in the portfolio is critical. Correlation being how they move together or how they don't in specific market environments. Okay? So the portfolios that we've laid out here, they have the same, it's 2 portfolios, portfolio 1, portfolio 2. The allocation to each asset in each portfolio is the same. So asset A is 56% allocation in each portfolio. The returns are also the same, 10% and 7% respectively. The difference here is if you look at portfolio 1 in that table on the left, the standard deviation for investment A is 12%. Standard deviation for B is 8%. If you compare that to portfolio 2, portfolio 2's A and B standard deviations are higher. Okay? Now, what we're going to get into here is the correlations. So if you look at portfolio 1, in the middle of the table, you have that correlation of 90. Okay, that's almost perfectly correlated. If they were perfectly correlated, that answer would be 1, and every direction 1 goes, the other would go exactly with it. Okay? So 90 is pretty close to 1. We would suggest that that is quite significant, and these two assets move together. In portfolio 2, which we've highlighted in the green, that correlation is only 10 basis points. So at 0 correlation, we're bound by +1 and -1. At 0, they really don't move together. One moves and the other one kind of lags. To this degree, 10 basis points is not moving very much with it.
Equity and cash.
Equity and cash, perfect. So what you see though is, even though portfolio 2 has 2 assets with higher risk than portfolio 1, the correlation between the 2 assets is less in portfolio 2 than portfolio 1. So if you look down in the other green section, the other highlighted section, what you see is both portfolios have the same expected return, but portfolio 2, because of the correlation, has a lower risk as measured by standard deviation. So if we go back to the previous slide on 6, that's going to affect your long-run performance over time.
So Mike, if it's a -1 and they move exactly opposite,
Yes.
what effect would that have then on that deviation?
Risk would be even lower.
This could be even lower. Yeah.
But there's not many asset classes with a perfect inverse correlation.
Yeah, and so leading to, I think it's the next slide. Oh, it's not, it's sorry. Sorry, was there any questions on 7 before I shift gears? I'm sorry.
So correlation tends to not get discussed as much as risk and return, but it's powerful. And we do pay a lot of attention and set a whole new set of assumptions in our asset class assumption process. It's just trying to estimate what those relationships look like.
And correlations change over time, which I think is also really important to note. During the crisis, I'm simplifying, but essentially correlations went to 1. Everything went the same direction, that was down, with the exception of U.S. Treasury securities or some of the sovereign debt securities, right? But since that time, correlations have come back a bit. There's been more dispersion. There's been the ability to diversify a little bit more. So they kind of ebb and flow depending upon what market you're in, which makes it also hard to model. Any others? Actually, the next slide's really easy. It's one of my favorites. Because it's quite simple, and that is, what this does is it plots over, since 2004, the performance of asset classes, and it simply shows that, from one year to the next, it's really hard to determine which asset class is going to outperform versus the others. Okay, if you just take one example, I think the green's easy for me to see. If you take the green, which is the S&P 500, and you just kind of step back about 7 feet and look at it, you can just see that it's over, up and down and around, over the last 15, 20 years. So it's really hard to determine which asset class is going to outperform over the long run.
So again reminds us diversification is really important because you can't see in advance which asset classes are going to do well. Who would have thought that last year real estate was going to be the best performer? And the other sobering thing is if you look at 2018, there's not many of these numbers that are positive. Right. It was real estate and then cash. So
I'm going to pass it back to Becky, actually. She's going to discuss a lot of some of the models. There's more questions on it.
So it's important going into this process that we know basically what our objectives are. We know we need to worry about what erodes wealth. We know we need to generate return to help pay benefits along with contributions. And so we need to think about these aspects in some kind of structured way. So we use a mathematical model. And as with every model, there's always benefits and drawbacks to using a mathematical tool. We use this tool to help have a conversation with you about some of the choices that you can make. But we all know that you put garbage into a model and you get garbage out. If you don't tell a model how to behave and what the boundaries are, that you can't have 100% cash and you can't have 100% private equity, then, the model isn't very useful. So we do use a model that most investors use. It's called asset allocation or mean variance optimization, which is a fancy way of saying that you're trying to find a good trade-off between risk and return. The benefits of using this kind of model is that it actually helps set up the diversification discussion very well. It focuses portfolio management activities on asset allocation as the most important driver of return and risk in the portfolio. And it provides for a really good analysis of what your risk-return trade-offs are. Some of the shortcomings are, as Mike just mentioned, sometimes the relationships among asset classes change over different regimes. Another example, in addition to the one he gave about the great financial crisis, is when I started in the consulting business, which is not much different than from when Mike started, just a couple of years apart. The correlation between international equity and domestic equity was much lower than it is today. And now with a lot of global companies, global trade, much more efficient financial models and news sources, we actually have seen correlations go up among many asset classes. So correlations are dynamic, but we have to model them as having a relationship over time. So that is something that is a drawback. We talked about volatility as the only proxy for risk, and so we'll talk about how in sensitivity testing, risk in a different way, which is, are you comfortable with a certain level of expected loss in a 2008 again? That's another way to think about risk, in addition to just looking at a standard deviation number. The models are really sensitive to small changes. So if you make a change to an expected return of an asset class, it will have an impact on the results. If you don't constrain the model, as I mentioned, it can provide very unhelpful portfolios to consider, and like the cash versus private equity. So there's a lot of things we know about this kind of modeling as we go into it. So it isn't the be-all and end-all of decisions that you make, but it's an important tool. On the assumptions, again, the inputs into the model are very important. We actually look at what we think asset classes are likely to return over the long term without managers outperforming their benchmarks. So we're looking at index level returns. And to the extent to which you choose active management, in some markets it isn't available to have passive management like private equity. You can't buy a private equity index or a real estate index of true equity real estate. But it allows you to have a baseline return over time that we think is realistic, and the extent to which you decide to have active managers and they're available helps add extra return on top of that. And so when we go into this, when we show you some of the assumed returns for the portfolio, think of, the staff and yourselves and us are all trying to collectively add additional returns on top of that base expectation through the other decisions that you make, such as manager decisions at the staff level.
Becky, have you gone and looked at your past capital market assumptions?
We have.
And seen how accurate or how they've been over time?
Yes, we have done that, and there's a little bit more discussion in the back about what capital market assumptions are supposed to do. We're trying to be as accurate as we can be with each one of the asset classes, but as important is we have to get the relationships among the asset classes right. And that's not a chicken's way of saying that, yeah, it's really hard to get things accurate. But one of the things, for example, that we did after the financial crisis is we actually, in time of crisis, went and increased the expected return for equities by a lot. Actually, we were conservative, but we were in the right direction. Fixed income, we've been early, whereas we've been cutting the assumed return for fixed income, anticipating a rising rate environment. We were early. Finally, it happened, and now we may be at the end of it for a while. So you'll find that the timing is not going to be as precise year to year, but we have a very long-term planning horizon here for a retirement plan. So we're trying to get the set of assumptions right, and we're trying to do the best we can with each individual assumption. And to give you an idea how some of these are built, and we'll talk about this a little bit more. In fact, if you want to turn to page 11, Mike is going to take this over, but He's going to give you a sense for where assumptions changed from the last time we had this conversation with you. But we look first at setting inflation, which Mike will talk about because he leads the inflation team. It's a great experience with the Fed, as many of you know, to actually lead that group. But to set the equity return assumption, we look at where dividend yields are. We look at how much earnings growth is likely to be additive to assumed returns. And then we look at the pricing for equities to say, are they overvalued or undervalued? And come up with an assumed return taking into account all those characteristics. And then look at how much return assumption you are left with, and does it make sense relative to bonds. So there's a build-up process, and we have a white paper that keeps getting longer every year. For any of you that want to see it, we'd be happy to send it to you. It's up to about 90 pages now. And it starts with inflation and then builds every assumption for you, so you can see the math, you can see the inputs that go into it, and the changes year over year. So we do look also at another real-world assumption. When we look at our assumed return and we look at what the actual returns have been, Jack, and we also look at what kind of return would you need to get to make the future reality make sense, and do a thumb in the air check to say, oh, that doesn't make sense. To have our return on equity to be correct, can we really assume that the market's going to return 15% each and every year for the next 20 years? No. We do some common sense checking as well to see how accurate we are. Now, if you look at a year like last year, where we had losses in the equity markets, did our assumed return that we put out for 20 years a year ago assume that particular result would happen in that year? No. But it looked at a long-term pattern of equity returns that contemplated 2018 and other years like it happening. So more to come on that if you're interested. But
I'm just worried that Jim's thumb would be in the air.
we take it down for now. Yeah. We make sure that the wind isn't blowing too strong at that thumb. No, he's a great source of collaboration and challenge. And just to give you an idea of how this works, and again, there's a little bit more of this in the back in the appendix, but basically we have two people that really lead the charge for getting everyone organized and set the standard for how we're going to work the process every year. We have a director of capital market assumptions, and we have another gentleman that works with him. They form asset class teams. They go out and study all the data available for equities, for example. And then they look what our manager research folks are telling us about equities. Then they start putting some numbers together based on those inputs that I told you about. Those numbers are submitted to those two individuals. They put together a presentation and get a team of senior people in the firm together to talk about, do all these assumptions make sense individually and collectively? And then all of our consultants and consulting staff get together and debate, which is a nice word for saying argue sometimes. Some of the arguments or debates have been over whether to leave inflation low, whether we should increase U.S. equities or leave them the same. Yeah, so there's always something to debate. And Jim is a great instigator of great questions to your point. So with that, Mike, you want to take us through the next couple pages on themes?
Just one point there. We've actually started already doing our assumptions for next year. So it's a big process that starts just as soon as we release the white paper and our 2019 assumptions. So we're already looking at the next year.
And for those of you that are closet mathematicians, and this is what you do for fun, we're looking at a fundamental issue of arithmetic versus geometric calculations. Chicken or egg, which comes first? So that's why we're starting so early this year.
So we have one slide in here that just kind of talks about the assumptions, and in particular, the 2019 themes that we think are important to highlight. That can just provide a really great background on kind of how we do it, why we do it, how the assumptions make their way into the analysis. So all I wanted to briefly do is just kind of highlight some of the big themes that we think were noteworthy that we changed. The first one, as Becky suggested, we did not change our U.S. inflation assumption, or our inflation assumption. There's a lot of ways that we look at inflation, whether it's expectations, measures, futures markets, or survey measures, or actual realized, and taking all that into consideration, we were comfortable keeping it static from where it was last year. Now, when we looked at equities and, non-US equity and fixed income, so the bottom right-hand side of that table, we did not change our US equity assumptions. We generally say that the valuations right now are still, pretty expensive, but we did see some volatility. So, our build-up models and our kind of forward-looking expectations, we were comfortable keeping those as flat for the US equity. And non-US equity, there have been some, valuation opportunities, I think is the way to think about it, that had us increase those expectations in the long run. International markets have not performed well, all things said, but if you look at the long run, we think that valuations should improve. Same thing with fixed income. Fixed income the last 10 years has really been an interesting market. There's been a lot of conversation about interest rates blowing through the roof or interest rates going back down to zero. As Becky had suggested, we were a little bit early in that call, and it was right. We did, expect yields to come up, and they did come up. I think one of the things that's a challenge right now is yields across the world, for lack of a better word, are really quite low. German yields are negative at the 10-year point, Japanese yields are negative at the 10-year point. So there's a lot going on in the fixed income markets. But we still think that there is room for improvements and likely some higher yield pressure in our equities.
I'll go back, Mr. Chairman, for a minute to the international risk.
Yes.
An issue like Brexit,
Yes.
obviously being a big mess.
Yes.
I mean, how, that's one not small point, but you could obviously overthink that or put it too much, but that seems like a pretty substantial risk thing out there. How does that feature into your planning?
I think there's two ways, I think from my standpoint, there's two ways to kind of think through that. One is, you can see this as it plays out in the markets. Every time you get some sort of new news on Brexit, you're not seeing material dislocations or material moves in markets. And that's because there's,
used to the
exactly. We saw
After the big vote.
right,
Yes.
yeah, exactly. And that's consistent with what I think we see throughout time with policy. There's an announcement effect, right? But then as it plays out over time, until you get to something really, really definitive, you're not going to see much in the way of market movements. The market's really good at pricing things in once they give you the details. So, we're seeing all these votes go back and forth and passing and failing and whatnot, and you're not seeing really significant moves in markets. And it's hard, from a macro standpoint, but also from a position standpoint, it's really hard to account for that and trade that. And so a lot of times markets will just wait to see how that plays out. We saw that with some of the policy measures during the crisis, things like that. You get that lasting effect, and you kind of go away for a bit until you've got better or more solid information. Thank you.
But doesn't the lack of solid, it seemed like the last 2 weeks would start a new announcement crisis, or whatever you call it.
But you've had concurrent announcements that have been more on the positive side, which is, we keep going back and forth, is the trade talks with China productive, not productive, not productive, not. We got some news on the Chinese economy being a little stronger than expected in the last few days. I think there's a fundamental understanding that this Brexit issue is having a dampening effect on UK's GDP outlook and currently, and probably will for a while. But there's also been, I think, in the last few months, there's post-2018, it seems as if investors have started to get used to the idea that we may be slowing global GDP growth to a more normal level. And at first that seemed a crisis as we got into 2019 or 2018 towards the end. Oh my goodness, China's slowing down. Oh my goodness, look at Brexit, what's it going to do to the UK? But the growth figures here in the US have been a little softer, but they're still fine. So I think there's just been a lot of news that have been concurrently happening. Some's been positive, some's been negative. But at the end of the day, keep in mind that investors tend to invest pro-cyclically. They look to the future and price in what their anticipated impact is in the economy is now, not necessarily in the future. So keep in mind the big dislocation the Brexit, the actual referendum had, and it was undone in a few days. So what we have done from an assumption point of view is to increase volatility for international equity for several reasons. One is currency, because currency is going to be noise all along the way, but we don't think fundamentally over 20 years is a positive or negative source of return. And then you've got a lot of individual countries with the possibility of events that could lead to volatility. So that's been our answer, is to increase volatility.
Any other questions on that slide or any direction that we were going or any questions? If we turn to the next slide, which is the opening slide, the asset allocation study, I'll start off briefly kind of talking about our assumptions, which is slide 13. And it's actually going to go to the question that Jack just asked us a little bit. And what we're showing here is the expected returns that we put together, and it just happened, and we have scaled it back to be just those asset classes that Montana is invested in, so that it's a little bit better, more applicable.
You don't want to see 35 asset classes.
We can give you that. It's in the back.
Yeah, we can,
But and what this does is this kind of highlights in many ways how the returns manifest themselves in the underlying study. So in the table on the left, you have all the asset classes that Montana is invested in. You have the arithmetic return assumptions that we put together. Those are all part of the white paper. The underlying returns that and the asset allocation model that we discussed in a bit. As Becky said, the standard deviations, we adjusted these to reflect some of the increased risk. But so those two columns represent our assumptions for return and standard deviation over, let's call it the 20-year assumed period.
What is an unacceptable standard deviation?
If you got a 5% return for a 30% standard deviation and a high correlation to equity, not real attractive likely. So if there's not enough payment, and if you look at the chart at the bottom, that's where you're going to go next. If you're way out to the right in terms of risk, and risk is measured on the x-axis and y-axis is return, if there's not a lot of payment for that return, and if you add to that a correlation that isn't helpful, then sometimes you have to draw a line and say, does this asset class make sense? And one of the asset classes that can fall in that category is just, you don't see it on this list, but straight out commodities, passive commodities. There's so much volatility in the asset class. It can have benefit from having low correlation to equities, but the return is hard to live with because it's episodic and fairly low over time in diversified baskets. So a lot of investors have chosen to have private commodity exposure or have other forms of that asset class rather than just its straight index-oriented forms. That's a good example for you.
And I think to further just kind of highlight that question is, you're looking at risk and return in comparison to all the other assets, right? If there's an asset that provides you a better return for less risk, that's a more optimal situation than an asset that's got a lot more risk and not as much return, right? So, to Jack's question a while ago, if you look at the scatter plot on the right, this is the long-run performance of the indices that we use when we're building out our assumptions, and you can see that while there is definitely the risk-return relationship you can see it. There's definitely some outliers there. It's tough to see on my screen, so I apologize.
International equity is that nice little line on the bottom right-hand
Right,
side.
there we go. So there's a lot of risk in that one for not a significant amount of return.
And the other thing we should mention is we've looked at the whole history for every asset class.
Yeah.
So it isn't a common way, a common period you're studying these asset classes together. This is actually their whole history. But it also tells you, in general, with some exceptions, asset classes over time that have had more volatility have delivered greater returns with some exceptions. We believe, this is called the capital market line, and if you look at ours on the left-hand side, it's not a perfect contrived, angle that is consistent at every point, but it has a general relationship starting with cash and moving all the way out to private equity and emerging markets equity, and it's basically saying investors need to be compensated for taking on risk.
I'm looking at LGTAA. Has that been around that long?
It hasn't been, but it's part of it's definitional too.
That's what I thought, but.
So, yeah.
That's included, because this is a long-term chart. That's what
Right,
I'm saying.
and that, we've got, data that goes back to 88% of the components, but typically it's going to include, it can include stocks, bonds, cash, real estate, liquid markets that can be expressed in a tactical product. Now, there's many forms of this. One could say there's, diversifying strategies that's being created here. It's about the only way to try to model a bucket of asset classes that are diverse among themselves, that as a total portfolio help the entire pension funds, for example.
Just do us a quick favor and run through A is broad US, B is broad world, equity, C is private equity, D is...
That's global natural resources. It's global natural resource equities.
Global natural resource equities, okay? Core real estate, and TIPS.
Treasury.
Inflation protected securities.
Yep.
Ag, FF, or F1, what?
That's fixed income.
Oh, okay.
It's kind of a broad fixed income.
Right. EMDH, what is it, Bruce?
Pop quiz. Emerging market debt.
Oh.
H is hard currency. It means dollars instead of local.
Obviously.
Yes, yes.
Okay. And then international government fixed bonds, right? International credit fixed income.
Intermediate government fixed income, intermediate credit fixed income.
Oh, intermediate, right?
Yes.
That's a T.
Yeah.
Oh, okay.
As opposed to long or short.
Right. HY.
High yield,
Okay.
global tactical asset allocation, and cash.
Just so I'm clear, the left-hand chart is your assumptions.
Yes.
Right hand is actual.
Actual longest history for every asset class.
Yeah, for the index,
That wasn't clear to me when I read it
Yeah.
last week.
It's not in here.
No, right. Yes. Any other questions on that slide? So if we shift gears to slide 14, this actually goes back to the conversation we were having a little while ago about correlations. Obviously, as we suggested, correlations matter. And an easy way to look at this is actually just to start with, say, domestic equity at the top and work from left to right. So domestic equity correlation with itself by default is 1. It obviously moves together with itself. But as you move to the right, you're going to see numbers that kind of ebb and flow. So international equity, as Becky suggested a second ago, historically that number was lower, but nowadays through globalization, through the electronification of markets, that number has creeped up higher. So there's a pretty solid correlation of 83 basis points. Private equity also is going to have a fairly positive correlation with domestic equity. Now, when we start talking about diversification, the broad fixed income, which is kind of that middle column that's the widest, at 16 basis points is a perfect example of why that's in the portfolio, right? That's an asset class that's not going to completely follow equities. You know, it's going to do its own thing, and it's going to provide value when you get, you know, a material economic downturn or any sort of economic downturn that impacts equity markets, maybe more so than fixed income. And you can see across the line. The high yield, you know, we talk about occasionally has some, it is fixed income, but it's got equity-like exposure, and you can see that indeed at a 62 basis point correlation. That's a meaningful exposure. You know, Montana's portfolio has you know, some notable equity risk, not unlike other public plans, but having this diversification helps.
And more than 80% of your volatility is really driven by your equity exposure, even though you've diversified very nicely. And that's just a fact of life, and it is with, as Mike said, most public pension plans.
I'm surprised by diversifying strategies having such a high correlation. And I would assume it's maybe just definitional, but I mean, the point of them is diversified, so it's not doing it.
Right. Well, and this is actually looking at how it's been built so far, and that number can change over time. But there generally has been, for many clients that are trying to form portfolios like this, it has been a challenge to try to get that correlation down. And in some cases, the asset classes that have been less attractive from a return perspective are some of the ones that it would actually help with that. But it is a little on the higher side, definitely. So with
Which
that,
number approaching one is, obviously we have both domestic and international equity.
Yes.
We know that that's both take advantage of the gains in both and for a certain amount of diversification.
Right.
But we don't get very much for it.
not as much as you used to.
Right. So I mean, is it at 0.9, is it, or is it 0.85, do you say to heck with it? It doesn't, we're not getting any diversification from it?
Well, you would look at this and say, at the end of the day, it's still an equity. It's like if we broke out small cap in this analysis, it would be higher than international versus domestic. It would be fairly highly correlated. But the things that these equity categories do, they all add risk. They all add different levels of expected return depending on how expensive they are coming into this process. And international equity, you're paying less for potential earnings or potential returns for international equity. So that's what makes it attractive, not this 83. The 83 is high enough to actually cause a model to start questioning that position to a certain extent. If that got up to 90, it really is not a whole lot of diversification opportunity there. It's very, very modest diversification at 80.
Right.
Well, just and something that Becky had said a little while ago, this also is just, these are passive approaches. These don't take into consideration that, the whole active management approach, which, if you went back into December and you looked at manager performance, active managers protected on the downside on a lot of those asset classes. So, you're not going to take the full exposure of an equity downturn. This might be something less when you start factoring in that active component.
Now, it may feel like we're moving slow in the presentation, but actually understanding how we put this together, what the model does and doesn't do well, what the inputs look like are really important because we're going to look at the output in just the next page. So you comfortable moving there? Okay, we're actually going to move to page 15. So risk, return, and correlation are put into this model. We actually assign minimum and maximums for every asset class. We know that you're not going to be absent domestic equity. That's an important asset class, so we do put a minimum on it. We know you're not going to be absent certain types of fixed income, so we're going to put a minimum on it. And we've actually broken out every asset class as it appears in your investment policy and in your asset allocation range reporting that you get from staff every single quarter, and these ranges correspond. There's only one new asset class that we are going to add into this analysis, which is that emerging market debt, and we'll show that to you in just a moment. But first of all, if you look on the right-hand side of this chart, what you should take away is looking at the green dot relative to the green curve of what the model says are the most highly efficient portfolios, you're pretty darn efficient. Your trade-off of risk and return is good relative to that model, and relative to what the model is saying. And you can see what some of the output there is. Your expected risk is about 12.6. Your arithmetic return, 6.6. Over time, risk will erode that return, so you're probably going to compound at something like 6% before managers add value above their benchmark if you have active management. So you're pretty close to that efficient frontier, and we'll talk about some of the differences between what the model would say and what you've done to educate you about what is the difference between 6 and 7 in your current portfolio. So first of all, check mark. You've done a good job. Even as we look forward for the next 20 years, your portfolio looks quite efficient.
Just in general, looking at other funds that you're aware of. I know it's hard to compare them, but how do we rate? I mean, do you have a lot of clients that are very inefficient, or is this sort of a standard?
You know, you are in a good place relative to the efficient frontier. As we look at the asset classes that you have participated in, they're very typical across public funds. One of the distances between you and that curve is that you've intentionally chosen to overweight domestic equity. And the model would say, we think we can get a little better portfolio if it isn't quite so heavily oriented to domestic equity. You have that in common with many systems, but some have just said, we're going to look like the world equity market. Regardless of where we sit here in Montana, we're going to look like the whole world equity market, which would still have a U.S. equity overweight that's smaller than what you have. That's one of the big sources of difference between you and the curve. And that is a decision that you can make. So if you plotted exactly on the efficient frontier, it could be that we didn't explore enough room around what you're doing right now and have already approved, and you need to look at being a little different than what you have been in the past to reassert or re-underwrite where your current portfolio is. And you sit in a very good place, and again, I'll point you to that. In fact, if you want to move to, we're going to skip a page and move to page 18. If you include emerging market debt as a new idea, as another source of diversification, and this is emerging market debt that is constructed of governmental agencies and sovereign debt issued by countries in US dollars, so you're not taking the currency, volatility of currency exposure. If you trim 1% from domestic equity and 1% from high yield compared to where you were at the end of the year, you can see you end up with that blue dot on the efficient frontier. And it's very close to where you are. It's not a new paradigm or a new investing philosophy that's significantly different from where you are. But one of the interesting things that it does, given its characteristics, is if you look at some of the numbers that are down to the right-hand side, below where the curve is plotting, the expected risk actually goes down from 12.6 to about 12.4 if you have a 2% position in emerging market debt.
Well, two things. One is it possible to invest in emerging markets without taking on the currency risk?
Yes, because these are bonds issued in dollars.
Okay. And then secondly, I thought that this was 1%, not 2%.
Actually, it's 2%. Diversifying strategies is just underneath it. So when you look at it real quick, I know when I was preparing, it made it look like, yes.
But you only took out, I see what you did.
We took out 1% from high yield and 1% from domestic equity.
Thank you.
And access to that market is how?
Access can be through either separate accounts or commingled funds. One of the difficulties that can go with implementing this asset class is working with your custodian if you want to have a separate account to actually set up relationships with all the countries that you want bonds in, but I suspect a lot of those are done. It's something that could be an implementation step, or you may just say we want a commingled fund, so someone else did that. So it's not hard to access. It is an asset class with volatility in it, so it's going to take some patience. But really the reason to consider it as an addition to the asset classes that you're looking at here is you get access to some better yield curves than what we can get in the developed world when Germany and Japan and others have had negative yield curves. But there is more risk out there in pursuing those countries. So it's an idea, and other themes that we looked at this year can actually be carried out within your other portfolios. You know, in past years, we've talked about private debt or direct lending is another area. Other pension plans in the defined benefit space in the public world have gone into to try to earn better return in a lower yielding environment. And things like preferred securities is something that could be done inside of your diversifying portfolios. So thinking about asset classes that could potentially be outside of some of those other buckets, this was the one that we modeled for you. So yeah, that's just what
And
the
is the idea that we're thinking outside our current budget because we're overweight in domestic equity and we need a place to
It's a great
put
point.
it? Or
That's
is
part of
just-
it. Part of it.
Or is it just time for us to do that as a diversifier because we're stuck with the same old stuff that we've had? I mean, what's the impetus for
What's the
saying we
impetus?
need to add more?
The impetus is access to other yield curves, other bond markets we don't have exposure to right now, but still having a sovereign credit, so not necessarily being in a corporate or non-sovereign. So access to better returns in fixed income. We know that we do have a lot of U.S. equities, so it's taking just 1% haircut off of that. It's also diversifying within your fixed income and by taking 1% out of high yield, which has had a tremendous run. So we're trimming a little bit at two asset classes that have had very strong runs in this cycle. To say, let's just diversify a little bit more with a different return stream. And it has a positive impact on the total portfolio. So those are some of the reasons that was behind our rationale.
How about our staff expertise to monitor these kind of things? I
Yes.
think I'm very proud of the way we monitor now.
Yes,
But the more there is to monitor,
sure. Diminishing returns, right.
and so address that.
Sure, it's something where it's always a challenge when you want to add a lot of strategies. You know, for example, you have a lot of fixed income strategies in your portfolio. If you turn to page 19, your policy actually calls out, and you've recently in the last couple of years separated out all the individual fixed income strategies, and those are handled very well. We've actually outlined in orange all of those fixed income related strategies for you. This would be another one. At the end of the day, it's not asking staff to have additional corporate issuer insight. It's actually saying, let's stick with the government and government-related world. We're also not asking to go into additional currency analysis because it is in US dollars.
So how does the staff analyze the government of Chile?
Well, actually, the staff would likely, I would anticipate that this would be an active manager that would be making that decision. And so staff would be hearing the plan of that emerging market debt manager and actually asking them, why are you investing in Chile in that much? And which of the credits in Chile did you decide to invest in?
How would the staff know whether it's BS or not?
They have us to bounce ideas off of. We're doing the same monitoring. We have folks that have been monitoring emerging market debt for years that can help with that. We also have other sources of information. Some of the other fixed income managers that we follow are managers that actually allocate among all the areas in orange for their clients in one big portfolio. And we can also see where their allocations are to get other intelligence from other fixed income managers. So we have faith in your staff to be able to add another strategy here, not to speak for Joe. Joe can definitely address that. But when we've looked at clients that have made this decision, this manner in making this decision and going US dollar only is something that is certainly going to simplify the decision and whether or not, or the implementation, and whether or not it's an active manager, which we would encourage, not just buying an index, but having an active manager And if it's in a collective fund versus a separate account, those are some implementation decisions that can be made.
So if for some reason, I don't want you to panic, but say we didn't have you next year, we have a contract.
Yes.
Are they gonna
Banish
come
the
back
thought.
and, are they gonna come back and tell us something totally different?
Probably not, probably not. Many of them, well, you'd have two schools of thought probably. One would be that some of them may have a neutral position before they saw your portfolio of saying, let X manager make the decision of how much to have in emerging market debt and how much to have in tips, and have it be a manager decision. Others may come along and say, have a dedicated position like this. But I doubt that there would be many that would say this isn't a valid asset class for you to consider. Good questions. I know we're right at the time. If I could take you through a couple more metrics, and then we'll just wrap this up to make sure that we keep you on time. But again, if you look on page 18, this is a marginal improvement in your portfolio. This is not a light, a beam of light telling you to do something very different. It's just a small adjustment to the portfolio. We think it helps with the portfolio's efficiencies. If you look at the Monte Carlo results on page 20, this is running thousands of scenarios, and it's actually helping overcome some of the issues that you get with this type of modeling we just went through that assumes that returns in equities have an equal chance of being positive and negative, and if you were to plot all those scenarios, it would be a perfect bell-shaped curve. This does not assume that. It actually assumes that a 2008 can occur. So we actually look at this and say, if you examine the one-year results, which are at the top of the page, and look at the blue-headed and the green-headed columns on the right-hand side, the green is the current portfolio, and the blue is the potential with emerging market debt. That additional diversification from having that emerging market debt can make that worst-case scenario the first percentile event, and 2008 was somewhere between a first and a fifth percentile event. So this is actually looking at how bad could a bad year get, and the first dose of reality, splash of cold water, is that we could, in our portfolio as it stands today, earn a negative return or lose 22% in 1 year. Absolutely within the realm of possibility. And what many plans face, even worse returns in 2008. But that certainly would be something that we think is still out there as a possibility. Adding a small tweak in the portfolio could make it a little less bad, but it's still bad. It's still a painful return. But that is the reality of having a portfolio that you need to have in place for 20, 30, 40 years to continue to add growth in the portfolio, to be additive to contributions to help make benefit payments to your retirees. And
So, going back to page 18.
Yes.
Given what you just said,
Yep.
and our job here to look at this in the long term, those two dots, green dot and blue dot, there's not a lot of difference between them. But that 0.15% over
subtle.
20 years or 30 years is in fact pretty significant.
It is, in fact, significant. Yeah.
And that's the whole thing of, we got a great big boat here,
Yes.
and just the slightest degree of correction will over time
Yes.
make a lot of difference in where the boat ends up.
Absolutely. And if the boat can experience a little less rocky seas by having the load spread out, I'm getting into gym metaphors.
I was gonna say, Jim not even here when we.
But it wasn't sports.
Well, I got her,
It wasn't sports.
I got you on the boat.
It's
so-
not a boat. I give credit for diversification.
You don't, you're not under the same quota, so don't
I
worry
know,
about
good,
it.
good. I'm gonna hear it. No, the load is spread out, right? It helps you manage the rocky seas a little bit better. So this is moving one piece of cargo to a slightly different part of the ship. I'll stop because I can't go any further than that.
What about ballast?
Ballast is important.
On the downside,
Yes.
but not on the upside.
On the upside, we think your compound return is going to be the same.
Right. Or a little less.
And it depends on, if you look at those different time periods, that's one of the things that those Monte Carlo simulations do for you. If you look at the median return, which is the darker gray on page 20, you can see that they're very, very close. In the longest term, it's 1 basis point more. In the 1-year environment, we shouldn't make any decisions based on 1 year. I tested you on the risk side of things. Could you tolerate for 1 year? But over the longest term, it's a small tweak. But when you're dealing with billions of dollars, it does matter. And if you're improving the efficiency of the portfolio, it does matter.
Yes. Great.
But importantly, the downside looks a little bit better.
So the downside. And when you say improving the efficiency of the return,
Yes.
you mean the downside for
Risk and return, yeah, combining them together, and it has a little bit less risk. So that was an hour and 5 minutes of asset allocation, a lot of work, that's preamble stuff. That's important for you to have any faith in looking at these kind of models. We believe that these assumptions are appropriately conservative. We try to create them as a set of assumptions. The conclusions are back on page 23. It tells you a little bit more about emerging market debt that we've already covered. And then if you want even more reading because you haven't done enough today, you can ask us for our white paper on the assumptions, and there's a little bit more about the capital market assumption process in the back in the appendix. A full set of assumptions, there's even more than this, but these are the ones people look at the most. And just a few pieces on market outlook, talking about debt overhang as well as GDP forecasts. But I think we're out of time. We'll pause right there.
Question on, you funded EMD with an allocation from domestic equities.
Yes.
Is it, would you go with just the 1% variation? Would there be a scenario where you would go beyond 1% from domestic equities? Or do you think our current position, we're clearly heavy, are we too heavy?
Right. We wouldn't necessarily say that if you were to trim more from U.S. equities that you put it in emerging market debt.
Right.
It would be more a conversation of, should we look at our whole equity portfolio, and if, are you comfortable in the balances where you are today, as opposed to just putting more in this new idea. And if we look at the difference between you and the curve, between where the current allocation is, and even, both the green dot and the blue dot relative to the curve would challenge you to say, are you comfortable with putting a little bit more in international equity than what you have? And it will support that from an efficiency of portfolio risk and return trade-off perspective.
I kind of thought on page 21, the probabilities was pretty interesting. That they were virtually identical almost in every time period.
Yeah, they are very, very similar.
To me, that says two things. Do you worry about the change, or is it worth the change and worrying about it? So, pretty small effect in the long term.
Emerging market debt and equities. Equities, you can go back and back and back and back. But emerging market debt, I'm thinking, is a much more recent point forward. Is that accurate?
Let's see here. We have got data, and yes, the answer is correct. We've got the index we use for modeling goes back to 99.
So a lot, well, 19 years, 18 years, compared to 70 years, you're right?
Yeah.
Does that create some additional risk because you have less of a window to look at?
Well, the same could be said of international equity because it is actually a full set of a fully diversified international equity benchmark is much shorter too.
Okay.
Anything compared to the broad bond market
So
or
if you
T-bills.
compare it back to then, everything's going to be, okay.
Yeah,
I'm
so
cool with
it
that.
is a consideration, but it's long enough for us to be able to say, we can observe the behavior of this collection of emerging market debt and try to understand its behavior relative to the other asset classes during the same period.
One more question. Looking back on page 17,
Yes.
where you gave us the 2016 ideas, and then we have the check marks of things we've done. And I'd like you to look at the 2019 ideas.
Yes.
Besides emergency corporate debt, and give us a quick explanation of those.
Okay.
Other places.
So preferred securities are something that could actually be contemplated inside diversifying strategies. And so that's why we didn't put a whole nother set of return assumptions on here. Is it, within the flexibility that's in that portfolio, that's something that could be attractive. Again, they've had good yields.
What are they?
Preferred securities. Actually, we've got a little bit of information.
Oh, it's in the appendix? Yeah, that's where I saw it.
Yeah, you were on the last page. Actually, we don't have a lot of data here, but we've had it in, I think, our 2016. It's kind of a specialty area of a higher yielding fixed income expression. Fixed income-like expression. Sometimes it's considered a hybrid of equity and fixed income. And so credit is an important consideration. In fact, a lot of times managers will include preferred securities sometimes inside of the debt portfolio to improve the return. One of the concerns about preferred securities has been, what kind of duration are you taking? What are the risk characteristics of those securities? And there's been some good products put out that have lessened that concern. So it is very much a niche asset class. If you look at some of the other ideas, we just get back to the page that you were referring to. Let's see here. Private credit, we talked about direct lending in 2016. There's a whole new world that was entered, a whole new world abandoned and opened up at the great financial crisis when a lot of regulations were changed about what banks could hold. And so it actually had the impact of lessening the debt available for corporations as they finance their operations. And so a whole new world of direct lending, or expanded world of direct lending, was made available. And so there's a whole new world out there where you can do direct lending of all different kinds and private debt of different kinds, syndicated and not syndicated. Those can be in a fixed income portfolio, they can be in a private equity portfolio, but basically the motivation is return, a better return than an investment grade security. They're very high quality, typically high in the capital structure of an organization, and they're a lot more liquid than private equity under normal circumstances. The funds have a quicker turn than private equity.
We have some, or we're looking at some?
We do have some.
Right.
We're constantly looking at. We've made multiple investments over the last couple of years.
And then infrastructure is something that's probably, even more familiar, where you're investing in many different types of projects. Some of them are public-private partnerships. It can be roads, it can be international, it can be domestic, it can be airports, there's all kinds of ideas that can fit within that. Sometimes it's considered a real estate-related investment. Certainly considered private, can be very long-term in nature. There are some equities they can buy that are infrastructure related, but mostly investors are thinking of them in the private space. So one of the things I didn't mention that can be a problem with this modeling is you get too many asset classes, and if too many of them are too highly related, the model has a hard time creating efficient portfolios. So we are mindful of making sure that we aren't dividing this portfolio into too many pieces.
Okay. Anything else? Thank you.
Thank you. This was fun.
Thank you.
Thanks for the
Nice to see you.
conversation.
We have a break until 2:30, and then Mike.
Okay.
Brandon?
We need a middle one.
I feel like we got Ringo Starr in at the...
What was the name of your band, Carl? I think.
Never mind.
You picked up that.
But I don't think that was.
Michael, you're up.
Let me step in. Hey everyone. Recently made a commitment to Foundation Capital Fund 9. Just signed documents yesterday. So they'll close in the next couple of days or weeks. This is an early stage venture capital strategy. It is probably the highest risk, highest return potential type of strategy within our portfolio. Fund 9, this is a fairly storied VC brand. They were one of the original investors in Netflix. That partner has since retired, but that sits within the firm. Now it's a bit of an emerging story with these 3 new general partners who are running the firm today. They've been together for the past 3 months, so Fund 6, 7, and 8. They've worked together for a long time, and now they're running the firm today. So it's more of an emerging partnership within a very storied brand. They're going to be making early stage investments. This is pre-profitability companies. They are focused on technology. They are technologists at heart. They'll make pretty interesting investments. One of the investments they've made is looking at the DNA of spider silk to create a stronger thread. They'll look at quantum computing, artificial intelligence. They are deep technologists in what they do. I'll pause there for any questions.
Are we in any of your other ones?
Yeah, this is a new relationship.
So just on a very high, quick level, what drew you to these people? I mean, I'm assuming the track record, but is there other intangibles or why this one instead of another?
Yeah, I think for VC, especially in our portfolio, is we're attracted to technologists, people that understand what's on the frontier and can look at potential investments as well as entrepreneurs and know how to communicate and understand what they're investing in, as opposed to that's a different strategy that has its own merits, is more of a high banking model where it's proven, there's scalability, you know where you're going to get. That's like a more late stage investment or just more of a high banking model. And so what these guys do and a lot of our other VCs do is they understand technology and are technically focused on the investments business.
Preferred return, normally we see that in some of these investments. Why, I mean, do you have an expectation that's not here, or talk about that?
Yeah, so this is different from other private equity investments we make, but fairly standard for venture capital. It is not having a preferred return. And it's something we would like, but are not able to negotiate with.
So they have internally some returns that they're trying to achieve, I assume. They just don't want to commit to it, or is that how it works?
Yeah. It's something we're not able to negotiate.
And what is there about venture capital that makes it so we're not able to?
It's, their history of success and their returns and their ability to raise capital. And so we probably could negotiate that with some lesser venture capitalists, but we probably would be wanting to have those discussions. It's, a historical practice within VC. We prefer to have a preferred return, similar to most of our other strategies. So it's a bit of a catch-22.
Anybody else? Anything else for us? No? All right. Thank you.
Thank you all.
Joe? Tab 5?
Yeah, Mr. Chairman, members of the board, we're going to turn to tab 5. This is going to be a little bit different and somewhat of a test as we move forward. not a test like a quiz test, but more like a trial run, right? So there's a whole presentation here, and it's information that happy to speak to any of it. But today, as indicated in the memo, I'm just going to make a few kind of brief comments about benchmarking, but not turn the pages of the presentation, right? There's no specific decision that is we're looking to make. There's no changes that we're looking to make. It's just every once in a while, we want to loop through kind of the importance of benchmarks and provide that education, and hopefully that's what we have in the materials and an opportunity for any of the board members to ask questions. So starting off, this whole presentation, as indicated in the table of contents on page 2, it's really about CAP, so the pension assets. But you can take this idea and really to any of the other pools too. We have benchmarks, so it's not, benchmarks aren't unique to CAP and in the pension space. But we, as listed on the table of contents, we have 13 asset classes. Again, I'm not going to go into detail and flip through each asset class, but happy to answer any questions there. On page 3, I want to start off with the key points here. When we are talking about benchmarks, we're talking about investment performance benchmarks. So it's a way that we can assess. We have the performance of the pool, CAP, an asset class, or even a manager, but the benchmark gives us a secondary way to assess, well, how good is that? Clearly, if the pool, the asset class, or the manager had a negative number, easy for us to determine, well, that's not good, right? But if it's positive, the question is, well, is that good enough, right? And so there are different ways to judge investment performance. The first and primary way, and as stated, and what we do, is really an absolute return, kind of a hurdle perspective, and that's our actuarial return. So, for CAP overall, for the pension plans, we're trying to achieve, that 7.5% long-term return assumption. So, when over a long period of time, if we get that level or above, that's like, oh, things have worked well, right? This that we're talking about today, investment performance benchmarks, is really a relative return view. It's comparing what we've done and how we've done it to a mixture, either a single or a mixture of benchmarks that might take on similar risks. That's just what's discussed by RBK in the asset allocation approach. How much equities do you have? How much fixed income? What types of equities in fixed income? And how much cash? So it's our secondary, but still an important measure of how we judge performance. And the third, that we won't get into today, but is something we're regularly doing, and RBK is always helping with, is peer benchmarking. What are peers doing, both from construction and portfolios and from return. The second bullet here that I want to highlight, because it can get confusing sometimes, and with our lingo, a lot of times we'll use index and benchmark almost interchangeably, and that can get confusing. Our benchmark, like I said, could be an index, it could be a peer portfolio, or it could even be an absolute return number like our actual return. But an index itself does not need to be a benchmark, right? There's quite an array of indexes or indices in the marketplace that we don't use and other people don't use as benchmarks, but they're helpful either to invest in some manner. So an index is quite often used at the same time when we say, it's a benchmark. We might say the index for domestic equity is the MSCI USA. But as we're talking about that, we're really referring to the benchmark of it. That index is the specific benchmark. So hopefully that wasn't too confusing, but we do use those terms, so question us sometimes if we use it, say, well, do you mean that's an index or is that a benchmark? And it's these benchmarks that we're using for the performance assessment and comparison. Any questions on the page? The second page is really the criteria, and this isn't just our criteria, this is criteria that years ago was published by the CFA Institute and many people utilize. I'm not going into detail with each of these things because I think after the bolded term you can kind of read what it's about, but each of them are important, and as we look at benchmarks, we have I'm not going to go through it, but the rest of the presentation takes each of these and looks at the benchmark for that corresponding asset class and gives a sense of, does that meet that test or not? Is that benchmark appropriate, measurable, and so forth. The one thing I wanted to highlight on this page is investable. That is one of the 5 criteria here, but to us, in terms of how we're using benchmarks, it's the most important. Because it's great to have a benchmark that might be appropriate, specified in advance, unambiguous, measurable, but if you're going to compare it to what we're doing, but you can't invest in it, well, how's that helpful, right? So we have chosen to err on the side of benchmarks that might not be as strong in one of these 4 other areas, but is investable in the real world, and is something that we, over time, if we look at our returns and we compare it to one of the benchmarks we have, we know, oh, we did better than had we invested in that benchmark, or we know, oh, we could have done better had we just decided simply to invest in the benchmark. The other thing I don't have here in writing that we say over and over again, but I want to make sure it's clear. When we talk about performance versus benchmarks, unless we make a specific point of it, we're always talking net of fees, right? So, and that is important because that could be one of the reasons why we might underperform a benchmark. Because even if we were 100% invested in an index fund, it will cost us to hire a manager to invest in that index fund. So, but it is that net of fee performance that we're focused on, and that's what we're always comparing to this benchmark. But this investable defines how we apply the benchmarks to each of our asset classes, and it's a little bit different. Again, as a reminder, we're not looking to change anything this time, but 2 years ago when we had the same presentation, we did make a change, and as an example, the private equity space. Before, we had a benchmark, S&P 1500 plus 4%, and for years we judged against that, right? But this one criteria that didn't meet, it met the other 4, but the last one investable. If we could have gotten the S&P 1500 plus 4%, we would do that all day. We probably would hardly have any private equity managers. Maybe some of the venture capital managers that we expect over time might do a little bit better than that, but it wasn't investable. So what we switched to 2 years ago and still have today is a US small cap benchmark that we expect over a period of time will do better than large cap. So it has that premium embedded in it, but it's still investable. We have a choice any day that we could invest in small cap, but in this case we're investing in private equity over time because we believe we can outperform over a long period of time net of fees that small cap benchmark. So that investable is very important to us. Others, talking about peers, may not have. They might have a private equity portfolio. They might even have, it would be a total coincidence, the same managers we have, but they might use some other benchmark, but chances are the benchmark that they might choose may not be investable. And so it's just a different thought process on how to use benchmarks. They might use a peer group benchmark or something like that. So, any questions on the criteria for benchmarks and specifically investable and what that means? The rest of the pages, make the assumption you have or you will flip through. We've included information on returns and some characteristics on distributions and sector weights, and thank you to Erin and Dan for pulling all this together. So all the information is updated, but I'm not going to cover it today unless there are other questions. And the way back, there's some more definitional of terms of each of the indices that we use as benchmarks.
Of all these, is there one that you have more concerns with than others? I mean, is there some that you would look to in the future, maybe changing or anything like that?
Let me break that into two parts, right? The first part, is there any that I have more concern of? I wouldn't say a concern, but when we incorporated 2 years ago, and even today, if you flip to page, and the page numbers in the upper right-hand corner, page 16, natural resources, right? This is the benchmark we have here, the MSCI ACWI, All Country World Index of Commodity Producers, right? This is an investable benchmark. It is very heavily weighted toward those people that are in the energy sector. Not entirely, there's other types of natural resources, people that are doing stuff with water or metals in this benchmark. But this benchmark meets all this criteria, but it is going to be more volatile, the benchmark, than the approach we're taking in the actual portfolio, right? And so when equity markets, which this is a part of the broader global equity markets, when equity markets are up a lot, like year to date so far, our portfolio will underperform this benchmark. When equity markets are down a lot, like it was the prior quarter, our portfolio will do well against this benchmark. So as a benchmark, if someone were to look quarter to quarter, year to year, maybe even 3 to 5 years, the concern is if the benchmark itself may be more volatile than our strategy. There isn't necessarily another benchmark, even one that's not investable, that is a great match. Maybe there's one on the private equity side, energy. If we did a carve-out, we could say, oh, that's comparable to what we do, but it wouldn't be investable, and that creates, I think, a more concerning challenge. So on that standpoint, Jack, that's the benchmark that I think is the most difficult to use, and therefore creates concern for me as a performance criteria. But over a longer period of time, we're still making the investments. We are in these private strategies within natural resources because we believe we will outperform that public alternative. The second part of your question, in terms of do I expect anything to change, right? One, again, no recommendation today, no anticipated changes today, but one potential thing that may come up as we go forward is within high yield, which is on page 19. So today, high yield is how we're investing those assets is very much in line with this benchmark, right? In some ways, how we're doing it is slightly more conservative, but this benchmark is a very good match for the investment strategies we do. But as we move forward, as we do our work, and we're aware of the work RBK has done on the asset allocation side and ongoing discussions there, and to think about things like EMD. Well, if we did 1% of EMD in our portfolio, instead of carving that out as a separate asset class, the best place for EMD to go is within high yield. right? And as we do that, that makes a lot of sense as RBK, position the case within the broader portfolio, but that might create some some issues in here, volatility around the benchmark. So at some point, we might say the high yield asset class should be a combination benchmark, a composite benchmark of this benchmark, this corporate US high yield benchmark, and the EMD backed benchmark together. So that is a potential change as we head down this path based upon these ideas on asset allocation and additional strategies, but again, not something that we're looking today or in the next few meetings of recommending a change there.
Joe, on page 26 on the cash equivalents, the investable is in yellow. Why?
Yeah, so this, so this is an index. The Federal Reserve U.S. Treasury constant maturity 1 month index. And maybe over time, remember this index changed in the last few years. We used to have LIBOR, but LIBOR is going away, and that's why we made the change. Now, this whole industry is moving in a direction of maybe adopting something new. At this time, if we had to guess, we would say it's the SOFR index that Kirsten and John talked about as part of the recent STIP presentation. And there's there will be things that around SOFR and previously LIBOR that make it investable. This, we can invest in treasuries. We could do it, but it's more a reported number than it is an investable number. So it's not red. It's not a concern. It's not saying it's not investable. It's just different than our overall strategy for STIP, right? And what we're putting, we don't have, it's that whole portfolio isn't made up of 1 month, U.S. Treasury contracts. So that's why it's yellow. It's not a big concern, but it's just noting.
Well, the reason why I questioned it, it's the only one that's not green, and you made a point of saying how important it is to get one that's investable as the benchmark.
And so it is a good question, so thanks, that's appropriate. This could change, and it could be very close to investable. If we only bought U.S. Treasuries in STIP of a 1 month maturity, but it's we know over time that we can keep that quality and keep that liquidity and do better, and so that's why it's yellow.
Okay. I'm just thinking it either is or it isn't investable, and I thought that was kind of the criteria, not whether you want to invest in it.
So we did all these other benchmarks. There are index managers that we know have strategies, and we could choose, or we could find an ETF that is investing in one of these other benchmarks today. We don't know or haven't engaged with anyone that has a strategy today that's investing exactly in this benchmark. Could we have someone do it? Probably, right, to mimic how this index is created.
It's just
yes.
We can do it ourselves.
This is over 10 years.
Right. We couldn't just buy treasuries.
We could do that, and we do buy treasuries within STIP, but this is all about, so we could do it if we wanted to try to mimic the benchmark, but we believe over time for the liquidity we need, which isn't as much as is in treasuries, that we can do better than that. Now, if you look the other way, if you say, well, why don't you select a benchmark that takes a little bit more risk than treasuries? Well, that's what LIBOR was, and that's what SOFR, as we look forward, may give us. But there's not a good investable benchmark within the STIP or money market space that is a good match that is riskier than treasuries, but not as risky as, say, short-term bonds.
So I guess my takeaway here is it's yellow because it's maybe not the best one, but Who knows
We'll
if there's
continue
anything better for
to,
right
yeah, will continue, and so maybe to answer the second part of Jack's question, if one does come up at some point in the next few years, SOFR becomes the established kind of index used as a benchmark within the short-term space. Don't be surprised if we come to the board and recommend us to switch it at that time. Jerry, you have a question?
Well, it's kind of the same question on 25 diversifying strategies. I mean, obviously, treasuries are not the only thing we're going to hold in that, but what you're saying, as I understand the second point, is because our goal for that asset class is to have the attributes of the U.S. treasuries, that's why it's an appropriate benchmark.
That's why it's appropriate, but it's also investable because today we internally, and we know of a number of managers that have index strategies that we could invest today in this benchmark if we wanted. So the actual benchmark of U.S. intermediate treasuries is investable today, whereas this index that we're using for STIP is just not a product in the marketplace. It's more of an index in itself.
But I would assume maybe over time, as we get more assets in that, more individual strategies within that class, something like that blended benchmark you were talking about for high yield in emerging markets might be appropriate.
It may be, and that's a conversation we should have. The trade-off is the simplicity here of the goal of remember, diversifying strategies. We wanted an asset class that was going to achieve positive returns over time, but protect us, help protect the downside when equities weren't doing well. Well, that's almost the definition of treasuries, right? So why not just invest in treasuries? So if we're investing in diversifying strategies, we want to at least do as well as treasuries, right? So that's the thinking there, but we could, as we've added these multi-asset class managers, as we consider adding preferred securities and other types of securities, we could look at the benchmark for each of those and roll them up to a composite. That's going to get pretty complex, whereas the high yield versus high yield versus emerging market debt, there's some complexity if we at some point had 2 or 3 components to that. But in diversifying strategies, we're thinking, there might be a group of, say, 8 strategies there, right? And it'd be a little bit more, I'm not sure the complexity of a composite benchmark would outweigh the benefits of just the simple goal of the benchmark. Any other broad questions about benchmarking? Again, this, interested in your feedback, but this, as we even roll to probably the next meeting in May, this is probably something we'll do a little bit more of. We'll give you materials beforehand, but we're going to be turning less and less kind of pages and just trying to talk more about the key takeaways from the past and talk a little bit more about kind of the future.
Thank you. Anything else? Hey, John? We have to turn pages with you, don't we?
You do. So I'm on tab 6, and to start off with, my apologies, I think the materials are a bit out of order. So I'm going to talk about the proposed STIP policy changes first, and I believe in your packet, if you look behind the memo, the first thing you see is the Montana Separately Managed Investments Policy. Put that one aside for the moment.
Okay.
And then right behind that, I think you see the Appendix 1, Schedule 1A for the short-term investment pool.
Yes.
That's the change, one. And then behind that is the short-term investment pool, the current policy. If you turn to page 8 of that current policy, you'll see the current Appendix 1A. So that we're all hopefully on the same page. Make sense? Okay. So A couple of highlights here. The majority of this.
I'm sorry, take me where we're at again.
So behind the memo, I think the first thing you see is separately managed investments policy.
Yep.
You can set that one aside. Okay. Then behind that is Schedule 1A for the short-term investment pool.
Yep.
That's the one where we're doing the changes. Okay. And then behind that is the current policy. And on page 8 of that current policy is the corresponding to Schedule 1A. It doesn't have all the markup on it.
The previous.
Yeah, current policy, as opposed to the proposed one.
Thank you.
Sure. So a lot of red on the proposed one. The main reason being is that we reorganized it. I don't know about you, but there are a lot of restrictions in the STIP policy. We do actually refer to it on occasion. Certainly I do if I'm covering STIP or something, because my memory's not as good as it used to be. So Kirsten kindly kind of categorized them. It's a little easier for me at least, to find the various things. So that's why there's so much red. In terms of important changes, we removed the restriction number 22 in the existing policy, which refers to what what floating rate benchmarks we can have. Joe mentioned the SOFR benchmark, which is new. It's not referred to in the existing policy. In order to sort of eliminate confusion there, and since we don't know definitively what we're going to go to with some of these floating rate benchmarks, we removed that portion. We put it up into the permitted investments portion, which just says the CIO will approve any floating rate benchmarks that we might use within STIP. That's consistent with other policies that we have, in pension plans and things, exact same language. We removed the restriction on government agencies. I feel like that's a relevant restriction, really. I don't know why we would want to restrict our ability to buy, government agencies. That's not where the risk is. All of those are either explicitly or implicitly backed by the U.S. government. And if it's a problem to have too much of those, then we have bigger issues within the broader portfolio. So we just removed that.
Why was it in there?
I don't know. Legacy. It's been there a long time. In reviewing it, just didn't feel that it was relevant. We removed restriction 5 and 13. So this refers to certain types of corporate securities. So we were restricting ourselves in terms of how much we could own of corporate notes or corporate CDs. But in the current policy, we are not restricting ourselves at all to what we can own, for instance, in corporate commercial paper. So the thought here is that corporate risk is corporate risk, by and large. We're not, we don't necessarily care that much if we own a note or a CD or a piece of commercial paper, and effectively, in the current policy, there is no restriction on it. We thought about putting something in there, but feel like we already restrict that in other areas. So by virtue of the fact that we have liquidity requirements, liquidity is only provided by policy via government securities of some sort, and or we have, as John and Kirsten have gone over with you previously, the kind of spreadsheet that we calculate risk for corporate securities relative to how much our STIP reserve is, and the length and term of the corporate credit risk that we might put on. We think it's restricted in other areas, not to mention limits on any particular name or ratings, all that sort of thing. So we're proposing to just eliminate those two restrictions there. And finally, just wanted to clarify that in concentration restrictions and issuer restrictions, it's at the time of purchase. That is how we've always run the portfolio, but simply put, you've seen the flows from STIP over various periods of time, so it gets higher and gets lower. If we have a 3% limit on a particular name, we're aware that, perhaps we're in the down leg of what the STIP overall balance is going to be. And we're not running it right up against 3%, the next day we're over, but occasionally that may come down enough that we would breach that for something that we'd already purchased, and we're not wanting to go out and sell small pieces so we get back under the 3% cap, because by and large, these are generally shorter securities anyways. In another week or a month, it's going to roll off regardless, and we're not, we may breach that occasionally, but it's like 3.01% or something like that, and we don't want to have to respond to that or get paid by auditors or something like that. Happy to answer any other questions on the STIP policy.
Just one quick one. A lot of these restrictions came after we had problems in the STIP policy that led to the reserve and lots of things.
I recall.
I'm sure you do. But anyway, do you think these restrictions would have mitigated those problems?
It would have, to some degree, yes. I mean, I can't ever say with absolute certainty that we're gonna avoid every problem, but yeah, absolutely we would have mitigated some of the issues that we had previously. No doubt in my mind.
And I like it.
So, Mr. Chairman, I don't know if you want to take these separately as far as the
I think we have
process.
to.
Okay.
So I think unless there are additional questions, we'll entertain a motion to amend the appendix 1 as stated in the memo. Somebody?
So moved.
Okay, is there a second? All right, any further discussion? Got it? You got it, Tim? All right, if not, all in favor say aye.
Aye.
Any opposed? None. Moving right along.
Moving along, thank you. On the separately managed investments, again, fair amount of papers here, but the big change is that we are adding the Historical Society to the separately managed investment policy.
Are we going back now?
Yes.
Yes, sorry, going back to the separately managed investment policy. So we added the Historical Society, so I think that's now the second thing that you see there. It's all in red because it's the new format, all of that. No real change here to the Historical Society from the prior, except big formatting change. The one exception I guess I would note is if you wouldn't counted all the accounts in the original policy, there's 16 underneath Historical Society. There's now 18. The reason is that we have 2 accounts that Historical Society has that are STIP only. In the past, we're not required to have a policy for an account that has only STIP. However, these 2 accounts could invest in trust fund if they so chose, and rather than come back to you later and add them in or something, since we already have a policy here, we just include it. No other changes to the overall policy. All these accounts can invest 100% in trust fund or 100% in STIP.
What number was that change you were just talking about?
So if you look at that, at the Historical Society, there's like 18 different sub-accounts that are listed here. So it's Schedule 1B, the one that's all red on the front page.
Separately managed, don't have any red, except a little bit.
It's toward the end.
There you go.
So John, does that tie with this one? Was this the
It
original
does, that's
then?
the original one. The original one, I think, is the last
That's
page.
16, that's when you said that's 16, okay.
All right.
So adding Historical Society, minor changes to a number of others in there where we're just changing the name. The reason we're changing the name is because accounting and operations and investments all got together and said, hey, let's have a common name for what we call things, whether it's investment policy or in the annual report or in State Street reports. We have done that, and so we're making modest changes to the names and a few of them to all be on the same page. And finally, I guess I removed some language in the kind of the body of the separately managed investments that refers to within the existing investment policy statement. There are no other existing policy statements because they're all now with Historical Society included in the separately managed investments policy. It's one document, nothing else applies at this point. Happy to answer any other questions about that.
So can I make sure I understand?
Sure.
You got rid of the things like the objectives and stuff, and you put in purposes and stuff like that now, is that?
Yeah, so a lot of that is
Kind of that
included
format like
in
we
the body of the original. We didn't, apologies, the entire document is like 90 pages long.
Yeah.
So we didn't feel that you needed to have that all again. It's on the website if you'd like to see it. So
you're
yeah,
just
so
trying to
it's all in there. It's all still
And
in
you're just
there.
trying to clean these things up, though, making them more like our other
Right, so now,
similar.
hopefully going forward, this is all much simpler. It's all in the same format, in the same policy, and I don't expect to have this volume of changes going forward. I hope.
Right.
So, Mr. Chairman, I make a motion to approve the changes in the Montana separately managed investment policy
And the appropriate appendices?
and the appropriate appendices.
I second that one.
All right. Any discussion? If not, all in favor say aye.
Aye.
Any opposed? None?
Thank you very much.
Thank you, John. Joe, it's you again.
My apologies for that. And, so we're
None necessary.
we're in tab 7, and I think there might be a benefit of pulling out the one-page memo and the stapled policy. Because I'm going to spend some time going through the policy, but if you could have the one-page memo to the side, it might be helpful as a means to understand some of these proposed changes. But before I get there, this is reviewing some proposed changes in the policy. We're not asking for a decision today. We will likely circle back based upon questions today and maybe questions between now and the next meeting, and potentially during the next meeting in May, ask for a decision. But if it takes more time, we will have more discussion in May and put off the decision until there's comfort to switch the policies. So no decision today. The other thing I wanted to mention up front is kind of thank you. Although I'm here presenting these proposed changes to you, I want to thank RBK. They reviewed this document and made some helpful edits in a number of places, so that was helpful. And also the entire investment staff had reviewed the policy, and these proposed changes are really coming out of discussions from the investment staff. So it's a collective effort, and so thank you to everyone for that. So again, with the memo to the side, I'm going to turn first to page 7 of the policy, which is the first change. And in the memo, you'll see that I broke down the changes. This is probably subjective, but I broke some down into clarifications and some that I think were more substance. Generally speaking, the clarifications had to do more with wording, and the substance was changing in number in the policy in many cases. And so even if it was an incremental or small change, but it was a number, I tend to put it under the substance. But that, if you're looking at the memo as we go through it, that's how you'll see them grouped. And so this first one is the clarifications, 1 in the memo. It's on page 7. Good for me to turn there. It's under the liquidity section, and you'll see this is kind of redlined or underlined. You'll see the word high yield underlined. So the proposed change is to add high yield to the list of asset classes here that we're considering illiquid. It's not nothing's changed with the asset class. It's just to probably clarify that we don't view high yield as a source of liquidity. It is not something that on a regular basis we're going to be selling high yield to pay benefit payments. We view other parts of the portfolio, STIP and cash and treasuries and fixed income and even public equities before we do high yield. So it's to probably more align it with these private asset classes as being illiquid. So that's the proposed change there. Please stop me at any point, because this is really to have the discussion about these topics. Again, we're not going to have a decision today, but if there's any clarifications or reasoning that I could provide you with, happy to do so.
So here, Joe, just to be sure, Right now, you don't use high yield as a source of liquidity, and you don't anticipate doing that.
Correct. Yeah. And, yes. Okay, so just flipping the page to page 8 under securities lending, and you'll see further down under proxy voting, and then even on the next page, page 9, class action litigation. This is one of the areas that I thank RBK for, and they have some operational expertise, and I think the wording changes here are clarifications. They're not changing what we're doing in securities lending, proxy voting, or class action litigation, but I think it's the wording as proposed is more consistent and more straight to the point. For example, under securities lending, before it said staff or the investment manager may restrict a security or a counterparty from the loan program, right? Well, lending is a better word than loan, and so that's why that changed. And the reality is the investment manager, we allow them to come to us and say, oh, we think we should exclude this from lending for this certain reason, or here's a counterparty you shouldn't use for lending. The reality is they come to us, we would make that decision and communicate it to State Street as securities lending. So it is clearer and more to the point just to say staff instead of the investment manager, although we still have an expectation that if the investment manager thought we should do something different, not loan or security, they would let us know. But they don't have the ability today to go directly to State Street as lending agent here and make a change. So that's why it's a clarification. And I'm not going to go through each of the reasoning under proxy voting and class action litigation. I think the words proposed here just make it clearer and some specifics of how the details work in each cases. They're, again, not changing what we're doing, just more an accurate description. Any questions on page 8 or 9? Okay. Oh, I should have mentioned, as I turn and see page 10, I should have mentioned at the top, nothing that we're talking about, and when we come back and ask for a decision on this, whether it's a May meeting or after, nothing we're proposing today is changing the ranges. So nothing in terms of asset allocation of the ranges, we're not looking to change any of that. The plan right now is to have that discussion and review those and potentially make a modification during the November meeting, but as part of this policy review, we're not touching those asset allocation ranges. So as I flip through the next changes that I want to speak to, the first one is under the U.S. domestic equity. It's actually on page 12, but at the same time, if you peek at page 14 under international equity, you'll see in both cases, and this is listed under the substance changes, reducing the minimum of the percentage in passive or index strategies for domestic and international. You'll see that the change we're recommending is to move it to 35%, so consistent in both places, right? Why did we have it consistent before? I don't have a good reason for that, and that's as part of the internal discussion and proposals. We just said, hey, we should have some consistency here because we really don't have a good explanation why today it would be 45% in U.S. equities and why international equities today would be 42%, right? There's nothing magical about those exact numbers, so we just said conceptually, we think they should be the same, and our recommendation is to lower them a little bit to 35%, such that would be the minimum amount of passive strategies in the portfolio. And the big reason for that...
Minimum amount?
Yeah, it's a minimum amount. So both within U.S. or international equities, we're saying that a minimum amount of 35%. Yeah, correct.
Have we maintained it greater in, we've maintained it greater in domestic of 45, right?
Correct, and 42 in international. So there's no problem. I mean, we're not recommending these changes because we're out of policy and looking to change the policy. So we have maintained the strategies consistent with the policy. The recommendation to lower the policy is to increase the flexibility to do more active over time, but it's also to remove a little bit of confusion of what potentially the difference between index assets and passive assets. So over the last few years, and as we look forward, we have started investing more in ETFs that are based upon an index, and you could state that, oh, that is passive, and that's the way we have viewed it historically, but we make active decisions sometimes where we hold a large cap ETF or a small cap ETF, right? And so there's some confusion potentially there between passive and indexing, right? You can actively manage index type strategies. And this is just increasing that flexibility to utilize a little bit more ETFs, but try to remove some of that confusion.
Mark?
Well, I didn't understand that explanation.
Yeah.
Because
It wasn't a very good one.
well, I mean, I understand the distinction, but I don't see how this solves the problem. So you have, but maybe it's because you have passive / index strategies, either or both.
Yeah,
so why does the deduction, okay, I mean, I understand the distinction between passive and active is not the same as index versus non-index, but I don't know why the reduction of the minimum is appropriate.
Yeah, so maybe as discussing this right now, maybe a modification to even these changes we have would be to maybe just say invested in passive strategies or passive index strategies, not including the ETFs, you know, to specify.
Something that, because this is still, when you use a slash, it's still got me.
So you don't consider ETFs to be passive?
They are, but the question is, you know, our use of them, right? And this gets back to what, even to decide to do an index strategy is not a passive activity. That's
deciding to put money into a passive strategy.
Right, but within
that definition.
within U.S. equities, as an example.
And you quote me on that.
Within U.S. equities, as an example, we have an overall benchmark, the MSCI USA IMI benchmark, right?
Right.
For the asset class.
Okay.
We don't have an index strategy that maps perfectly to that index. That index is broken into two components. One is called the standard MSCI USA, and that is the large and the mid cap, and then there's a small cap component to that. And then we have ETFs in both spaces because over time, cash is coming in or leaving the portfolios, and we don't want to, it potentially improves the liquidity and the management of the portfolio to have ETFs. But when we select an ETF, we're selecting between a large cap ETF and a small cap ETF. Those ETFs, their goal is to track that index in the ETFs that we're purchasing, but our decision whether to purchase that small cap or that large cap ETF is an active decision, right? Are we going to bias the portfolio more towards the small side, or it's not mimicking the overall asset class? So it's not a problem today. I'm just trying to avoid confusion as we move forward, and because these ETFs have become a more liquid, lower cost way of managing liquidity in the portfolio, where historically we use futures. But I also want to recognize that the ETFs that we're buying aren't replicating the index, the benchmark for the overall asset class. And so that decision in itself, one could term as an active decision.
So are we, by changing the number, indirectly or directly saying we like active management?
Changing the number, we believe there are opportunities for active management. We believe we would like to have the flexibility to look for active management. And if the opportunity that we identified managers within the structure that we thought net of fees would outperform a non-active strategy, yes, so it increases that flexibility. And I do, recognize that this policy change, as we're thinking of this is thinking longer term. This isn't something saying, oh, it's because we're out of policy today we need to change, or we're anticipating a nearer term to make this change, therefore we got to expand the policy. It's thinking a longer period of time, whereas over a shorter period of time, we are headed in the direction that the assets within the U.S. equity will be more passive than active than they are today. And so it is counter to that shorter term repositioning of the U.S. equity portfolio, but it's consistent with the concept of how we believe U.S. equities should be managed over time.
Yeah. So, but I mean, if we made this change right now,
Yeah.
we could, in theory, come back in a couple of meetings and be in our domestic equity portfolio 65% active and 35% passive, right?
Correct. If we made this change today and if we implement it,
Right.
I'm looking to make the change today.
I understand.
Yes.
You're not looking to do either one of those. I'm
Right.
just trying to understand the impact.
And maybe, through the discussion, maybe there's some improvement in the wording here to include this concept of ETFs and make clear that going forward, although they might be index strategies, we would include them under the active.
And I don't understand that. Because what I understand you to say is that the decision of which ETF to use is an active decision.
It is.
But that's true with everything. I mean, you can't make a decision without the decision to put money into a passive strategy.
The different, say if the only thing is we did was ETFs in U.S. equity, 100% ETFs.
Okay.
We could select 100% of ETFs that they're trying to match a particular index.
Right.
Right? But none of those indexes might be the benchmark for the overall asset class. So if I told you the strategy was 100% passive, the expectation is that performance should match the performance of the benchmark. And so that's what it's trying to get at, that again, it's a fine line in terms of what we're calling active or not, but it's just clarifying that if we were 100% ETFs, based upon the types of ETFs and the position there, that we could actually have a different risk. We could be overweighted small caps relative to the overall asset class benchmark for U.S. equities, and our performance could be better or worse.
Right,
and
but
so,
here's my concern, Joe, and I'm just going to say it. We're a very public fund, and part of the public debate is, are we too active or should we have more passive?
Sure.
And we've heard that. We've heard that from not this session, but certainly the last session, we heard it in the form of a bill to say that we had to be more passive than active, or whatever it was. And so I hate to put us in a box where we're calling something that is by definition passive. We're calling it active and adding to the to the confusion, debate, I mean, however you want to call it, that we get because we're so active. I mean, because we're so public. I get what you're saying, and it's being.
Agreed. Again, there's no ideal choice here. That the proposal is based upon, I'd rather us raise the issue, have the discussion, take the conservative view that some of these ETFs we're going to put in this active, as opposed to a few years from now, us using ETFs, someone coming back and saying, well, you weren't passive in U.S. equity, because look, your performance is different, right? And so we can go one way or another, right? It's not going to have a big change to the portfolio, but this is an important discussion to have, to be clear up front that if we use ETFs that aren't an exact perfect match for the overall benchmark for the asset class, don't expect us to perfectly match that return of the asset class, right? So that's the only difference. I'm taking more the conservative view. Yeah, I'm lowering the minimum for passive assets, but to include kind of ETFs and active, and knowing that we might have a small or a large cap weighting there, is a conservative view that, and most people that are questioning us are questioning because of the fees and the performance. And so I think we can address those same issues no matter which direction we go here.
Joe, it seems to me you have two issues here, and I don't see where I see uniform, made the percentage uniform and reduced it. But I don't think you changed any confusion in my mind as to what is included in that percent. If ETF funds are or not, and the index funds are or not. I'm guessing what you're saying is, since you have passive/index, those would all be considered passive. Whereas if you have ETF funds, it's still open to debate without any clarification in language.
So my suggestion, and so the good thing is we're not looking to make a decision today. I think we can improve the wording. I think there's some opportunity to have some additional educational discussions around this topic, and so maybe if we could move on to the next part.
You understand.
I do.
Great.
And so if we go to Schedule C, because that was the only change in international equities, under private equity, and if you turn to page 16, right in the middle of the page it says other restrictions, and if you read the following restrictions, that sentence, again, this is at a suggestion of RBK, we're just clarifying that, hey, some of these percentage numbers we put here, we're able to, we calculate percentage numbers of such we can compare to what's in policy, but sometimes within these private asset classes, the numbers aren't perfect, right? They're lagged a quarter. So this following restrictions is just saying, hey, these market values, may be current, they may not be perfect, the best we have, and it may not be feasible due to the illiquid nature to make a quick change. It's somewhat complementary if you turn to page 17, the last paragraph that we have in the current policy that's basically recognizing that, hey, if in looking at this, we go outside of any of these policies, if it's prudent not to correct it quickly, then we'll come back to the board and suggest that, hey, we're delaying getting back in line because it's in the best interest of the plans. So this is just additional language to make it clear that when we're talking about private assets, the pricing and the liquidity aren't perfect, right? And it might take some time to make adjustments. So that's why this, and you'll see this a few more times, you're going to see this under the real estate guidelines and under natural resources, adding in each to just add that additional clarification that private assets are not as easily, feasibly adjusted as the public markets.
Am I under the new number 7 there,
Yeah.
you intended to exclude those policy ranges because you have put those minima up above there.
Yes.
And then, but following that, excuse me, the blue, what's blue and light sheet there?
Yeah.
For the purpose of the ranges provided above, is that meant to be still there, or should that have been excluded?
That should be excluded.
Yeah.
Yeah, so that was, thanks for that, Mark. That was the section I was getting to next, and I was going to start by looking at page 17, where we have this table. And please, as Mark suggested, the appropriate thing would be also to show a cross out for that sentence that begins for the purpose of the ranges above, cross that whole sentence out. But the reality of that table is to say the most you can have is 25% in venture, and the most you can have is 25% in debt related, and everything else has to be in everything else. Well, we're removing the table because it might be clear, but it might be confusing. We decided just to replace that with 3 and 4 that specifically state the most you can have in venture is 25 and the most you can have in debt is 25. So to me, it deals with numbers, and you might say it's a substance thing, but it's really a clarification cosmetic change. Any other questions about that?
Now, as I thumbed ahead, I just want to make sure we're clear that all the other times that you've made this.
Yeah, I'll need to.
No, all the other times that you've added this,
that reference
preparatory language in other restrictions, we already have the last paragraph in policy. So there's still a requirement that if we're out of range, the CEO needs to come to the board meeting and explain, and at least inform us.
Yes, that's true everywhere.
Okay, that's what I want.
Across the policy, yes,
Okay.
yes.
I saw it in natural resources.
Yeah,
Right.
it's true everywhere.
That one sentence.
Right, okay.
Not looking to remove that, looking to just add this additional clarification.
Right, but
You don't want to delete that last paragraph under number 7, that's what his point was.
Correct.
right,
Yeah,
and then any place else where he's added that new language, we've got it in now.
we're
Right.
going to maintain that last paragraph in each of the
Thank you.
guidelines. Sure. So flipping to Schedule D, starting on page 18, but really focusing on page 19, and this is under natural resources. At the top of the page there, and again, this is a clarification, we historically, as we started investing in these type of asset classes within our private equity portfolio, remember a few years ago, we separated them out from private equity. We separated the energy assets out from private equity and the timber from real estate, and we put in natural resources. But historically, we have only invested in private equity. The policy and allows us to be more flexible and invest in natural resources, but within that private equity, but within public equity. Again, our benchmark for the asset class is a public equity benchmark. And so if we think that is best, we should just invest there with lower fees if that's the return we think we could get. And then the expansion over time to include kind of debt is also true. Why, if at different times we don't get as paid as much to take on the equity risk, say if we got as paid as much expected return to be in debt, well, why not be in natural resource debt instead of equity? And so again, it's just making that clear that our approach, as RBK pointed out from their comment, their suggestion a few years ago, and even in 2019, this direct lending or private equity, private debt investments, and as Michael said, we have made private debt investments. It's just to clarify that point, right? And so that's why that is being added. You'll see very similar language to these changes that are made on proposed changes made on top of page 19 when we get to the real estate asset class, because it's the same thing. Questions about that? Halfway down the page, it's the same thing, under other restrictions, saying the following restrictions, it's that same language, and again, we'll see it again under real estate. 1 and 2 are just a removal here, and this is a proposed change, both under substance. Number 1 said, hey, timber investments shall be no greater than 2% of the overall cap asset classes. Natural resource as an asset class is one of the smaller asset classes. Timber is a component of that. Right now it's below 2%, no immediate plans to bring it above 2%. But I think, not sure that it's needed because we're not viewing timber itself as an asset class. Think of timber within natural resources, although technically our exposure there is more as an equity investor in this timber. The return and volatility profile is more fixed income like, right? So we don't expect timber is going to do well as the other equities in the portfolio. If we invest in timber, it's really expecting it's going to outperform fixed income, but have an ability as a diversifier to the natural resources asset class, but also the broader portfolio because of that profile of timber. And timber is used for building purposes, and therefore it helps protect against inflation. So so suggesting removal just because it's already a small asset class, and now that we've broken this out of this was the case when it was in real estate. We have the 2% restriction, and so.
But we don't want an overall restriction for natural resources?
We do have that. So that's back on what was it, page 10? So we have, it's part of our asset allocation ranges, but that's somewhat part of what I'm suggesting and why I think we remove this. We have that restriction for natural resources, and it's, we've defined that maximum exposure now as 6%.
Got it. Okay, thank you. I got it.
Okay. Questions on that? Again, not looking to make a decision right now, but.
Just as a overall question, when we have these policies for the individual asset classes, do we have in any of them that what percentage of cap they will be, or do we understand my question?
Yeah, the only other restriction at the cap level is of the manager itself. So we say the most one manager can be of cap is 5%.
Right, but I mean, in any of these others, do we have similar language to what we're removing?
I need to double check, Carl, but I believe in the other
I mean, if you're saying it's not needed here, then let's make sure it's not in any other
Correct, yeah.
policy.
I believe in the other asset classes, it is relevant to the asset class itself.
Okay.
And whereas in this case, because the asset class is so small, we could put that restriction. We could say, well, timber will never be more than, 50% of the natural resources asset class, or a third, or something like that. But it's.
All right.
So I have a question.
Yes.
So the second one, Joe talks about the 1% for any single investment within natural resource asset class. Timbers is one of those single investment type things, right?
Correct.
So I'm just thinking back to that issue that Ethan explained to us last meeting about, was that considered natural resources?
Yeah,
the trees down
that was
there?
timber and
And
natural
timber.
resources, yes.
And what percent was, I can't remember what the amount was.
Well,
0.3 or something.
It was some small amount.
But that, this restriction, so there's the asset class, natural resources, there's timber within that. Within timber, we have a few managers, and within the managers, in the case you're referring to, the managers can have different funds. This guideline number 2 is down at the fund level. It's kind of saying in a single investment within the natural asset classes. So if we had a manager with 2 funds, each of those individual funds is its own investment. And so Again, this is a little bit unique to natural asset class. We have a restriction at the manager level at the cap, as we look broadly across cap, but
That's the 5% you're talking.
correct. But we're 1% within natural resources, which at maximum is 6%, is, a pretty small number. So removing this guideline really doesn't add risk to the portfolio. It's not that useful today. And that's why the proposed kind of removing it. Page 20, striking out the timber fund leverage. And this is, in the memo, is number 2. This, it's important before we look at the actual wording of 20 that's crossed out. If you go back in the investment policy to, what page, sorry? 7. Page 7. That starts with the leverage language. So this is under page 7, it says D, leverage. And it notes that leverage is a significant risk factor and talks about how we look at leverage and the importance to us, and it's clearly a risk, because a fund that is over leveraged, it gets too risky, right? But how we do that, particularly in timber and real estate, that we're suggesting the removal of this leverage language. The reason for removing it is it really doesn't add anything beyond what we already have in the policy here on page 7 under leverage, because our true due diligence on leverage is upfront before we decide to go into a manager, and we agree to, if it's a private fund, the specific guidelines of that fund, or if it's a separate account, the guidelines we give it. If the fund has too much leverage, we're just not going to invest in it. So we do that upfront work to identify those that amount of leverage. Whereas, so that's the reason removing it doesn't say, oh, we're going to take steps to be really leveraged here, right? We think that our view on that doesn't change. It's just recognizing that our work on leverage is more an upfront work. Whereas if we go back to the guideline language that we're proposing to remove on page 20, the line that I want you to, it's difficult to read, is really the third line down that starts with the word on. On a select basis, the leverage may exceed 30% of a given investment if it's determined that it's reasonable to do so. And it says particularly early in the investment. Well, every time since we've had this guideline as we're monitoring it, that particular case comes up, right? And we know it's going to come up at the beginning of almost every fund. Because what happens is when a fund is first created, they draw down on a line of credit, of which we understand they're going to do, but if they draw down on that line of credit as they make their first small investment, they're 100% leverage. We haven't put any dollars to work. It's all in finance dollars, right? And so we routinely are at the point that we're saying, yeah, okay, it's above this guideline, but it's reasonable because we understand that, and we understand the rules and regulations that these funds have to adhere to, because either we have separate account guidelines we've set for the manager, or the fund documents have very formal leverage guidelines, and they're adhering to those. So I think if we remove this timber fund language, and you'll see in a minute in the real estate similar section, but keep that leverage language on page 7, which is a key part of our due diligence process up front, I don't think we're changing the risk profile of what we're looking at. It will just give us less, what's the term, kind of false positive, false, I always get it wrong, but it's all these compliance things we come up and we're like, oh, of course, right? Well, the fund just started, that's why it's above this level. So that's the reasoning there. Again, it's not, it's more, in my mind, a clarification than it is a substance change, but we're not trying to take more leverage here.
So assuming the board wanted to decrease the leverage, then would that involve going back to 7 and say making that smaller?
Well, in
Seven doesn't have it.
seven itself just notifies it as important. If the board wanted to have a specific level, I think better to put it right in there. Because then it's something that we would make sure any investment we made, that we would not be exceeding that level, right? And so I would do it there instead of, so up front instead of at the end here in the deadline.
And why shouldn't we have a number?
You can, right?
From
Our
an
highest,
investment policy standpoint, not from the standpoint of you wanting to take on leverage and us not wanting it, but from an investment policy, maybe this is a question more for Becky, but why shouldn't we have a leverage, a number?
I don't have a good reason why you shouldn't, right? But the only reason why you should is if you have a precise number in mind, right? And so our highest amount of leverage is within the real estate and private equity asset classes, and almost everywhere else, the leverage doesn't even compare to that. But say if you said, oh, we will not, leverage an asset class or a fund, more than 100% or 75%, we can put in that number. We haven't formalized the thought process or around that from a board discussion to say what is that precise number, but it would really only apply to those asset classes that truly utilize leverage.
From a best practices standpoint, should we have a number?
Usually it's applicable to the asset classes where you're going to find leverage rather than having a blanket leverage statement for any investment. Some of the things that could be done or considered when you've got this early in the life of a fund where there is a credit line is to actually make an exception to that language saying, except in the early years of a fund when a credit line is available or something like that. Still may be a problem to program for compliance, but at least the intention of the leverage is to apply once the fund is drawn and actually operating.
But so if you, so is it, again, so I understand it's in the, you'd have it in your specific policy statement for the asset class, which is, we're taking it out here.
Right.
And I'm asking, is it best practices to have a leverage number in the specific policy for the specific asset class?
It's a good guideline to have it in your policy, but also being clear that in your operating policies of choosing funds, that's one of the decision criteria, is actually examining the amount of leverage that your timber fund is going to use, or that your real estate fund is going to use. There's characteristics of non-core real estate that have different levels of leverage, but usually there's a maximum tolerance that you will entertain per the terms of the agreement of the fund that you're actually looking at. And that's usually what you're stating in your policy.
So my suggestion here, again, we're not trying to switch what we're doing, we're just trying to get the wording right.
Right.
And so maybe between now and the next time we look at this, we'll propose new wording. Maybe we'll leave it in the asset classes, but we'll make it clear, we'll use a specific number, but we'll make it clear that we're not going to select funds or create guidelines up front, right? So we will not approve funds that where their guidelines have leverage more than X percent.
Exactly.
Right? And that way we're not monitoring it every day, but we're also making sure from a policy best practices standpoint that up front we're doing that.
Right, we're not buying into higher.
Yeah, and so that's what we're doing today. So we can, when we come back with the wording, we'll modify that to align with that type of thing.
Thank you.
Under real estate, page 21, you will see the similar language to recognize the four-quadrant private public debt and same type of reasoning that I explained before. Same thing under just inserting the word investments, because if it wasn't clear before, and and removing the word public before long only, because in here in real estate, we're using long only strategies in private too. So it's just improving the clarification, removing that. And then the end of page 21 here, where you see it's defining real estate core. This isn't new, you'll see when we turn the page, it's just putting it here as a definitional term to define for clarification, whereas before it was embedded in a restriction. So we're just defining it up front. On page 22, you see under other restrictions that same language again that was under natural resources, private equity. The substance change here under number 1 to decrease from 30 to 25% of core is an important change because historically, as we invested in real estate, it was real estate equity and it was really real estate private equity, and core defined at the low risk end of the spectrum. There was then value added and opportunistic that was more risk. So we wanted to have at least 30% of it in core equity to kind of create that anchor defensive position. Reducing it to 25 isn't necessarily taking more risk on. It's recognizing that we're going to be incorporating more debt strategies, which we would consider in most cases to be lower risk than real estate core equity investments. And public equity, like a public REIT strategy or an index strategy in the public space, mimicking the benchmark we have for the asset class, that would be also less risk than the core strategy, but it's difficult when you look to the public space or REIT to say, well, this is core, or this is not core. So it's to recognize that our opportunity set is growing in the things we're looking at as the more defensive part of real estate, i.e. public equities and public and private debt, allow us to kind of minimize core because that's no longer the kind of anchor within the portfolio. It's still an important part, but that's the reason for proposing a 5% reduction. And that's also the reason as you go for 2, it's being clear that non-core has always meant to us private equity, but it's just adding those words as a clarification here. Because non-core is difficult to apply when you're talking about public equities or debt. And then lastly, number 3 here on this page, crossing it all out, this was a restriction that said, hey, you can't have more than 20% basically in public assets. It's back to that idea that we're using a public benchmark. If we thought the public benchmark would give us the same risk-return profile as private, why pay higher fees, right? And so we're just saying, let's not restrict us from buying, positioning the portfolio equal to the benchmark if we thought it had the best return risk characteristics. So that's why it's removing that public restriction. It's recognition that the benchmark for real estate is 100% public benchmark because it's investable, and it's not forcing us to buy private even if it just gave us the the same risk return but for higher fees and less liquidity. So that's the reason for 3. And on page 23, the removing of the leverage is the discussion we just had. Update that in the same manner as we talked about natural resources. But questions about any of those real estate changes? The next one, I'm going to have you actually flip through quite a few of the fixed income because the only fixed income we're looking to change is high yield, which is on page 34 and 35. The actual changes proposed are on 35. And you'll see the changes are in substance and a clarification. The numbers from increasing a maximum of 10%, the first one, to 15, high yield asset class and non-US securities. And then number 3, from 10% to 25, specifically in emerging market debt, is very much in line with what RVK talked about, increasing the exposure to emerging market debt. And if we did that, that's the specific reason why to increase the 10% of the high yield asset class. So for example, say if we implemented 1% within CAP, right? 1% within CAP today, the high yield asset class today, we have about 4%. If we took one of those 4% and made it 1%, it would be 25% of the high yield asset class, right? So it is just allowing us to kind of move in that direction to add somewhere in the neighborhood of a 1% allocation to emerging market debt, but put it in the high yield asset class. And the 15% in the beginning of non-US securities is really the foreign currency. As Becky talked about emerging market debt, a lot of the emerging market debt, and we could restrict it to only be hard or US dollar currency, but some of those strategies that we have been evaluating do have as a portion of their fund or portfolio they run some non-US dollar exposure, and so it's just, that's why this slight increase.
This is so minor, maybe I'm not getting it, but it shouldn't be shall in all these, it should be may, right? You're setting a maximum.
It's a maximum shall be. The maximum shall be, not the minimum shall be, the maximum shall be. So it's no more than.
So what you're saying is the correct word may or shall, and I'm willing to switch it to...
Well, I don't know, I mean, I can understand, but, I mean, you could read this as we have to have.
No, that would be if it's a minimum shall be. This is a maximum shall be. So that's my question, and that was my question. I mean, to the extent that we continue to have this discussion about the point that Becky raised today, or RDK raised today, on whether or not this emerging market debt is a good place for us to be moving resources into, at least for now, subject to change. From my standpoint, one of the selling points, if there is one, is that it's in dollars. So that would be a restriction that we could impose in here, correct?
We could go, this clearly is given more flexibility to say probably the majority would be in dollars, but some small portion may not be. Some of the funds that we've looked to have had a small portion that are not in dollars. Again, back to the emerging market debt, we currently manage and monitor managers' emerging market equities, right? We, in those equities, have that currency exposure, right, in the equities. So this is doing nothing different. You know, we're looking at those emerging market countries, managers in those countries, those currencies. So we're doing all that in a more risky asset class, emerging market equities, which are 25% of our international equities portfolio, a much bigger percent. This is in some ways saying, well, over time, if we wanted to get more conservative, but we like the emerging markets, should maybe we move some dollars from non-US equity, which includes emerging market equity, into emerging market debt, right? Should we take some dollars from US equity into emerging market debt? But the fact that it's in debt, yeah, the currency adds some volatility there, and in some cases it could add a fair amount of volatility, but the amount that we're talking about is dwarfed by the amount of emerging market equity exposure that we have in those currencies today.
I understand, but if,
we can go either way.
Right,
I mean, this first guideline, we could keep it at 10% and not change it, but it's just recognizing that a number of the strategies we looked at had the majority of their approach contain US dollar assets, but in some cases, they're investing in local markets because for the same bond, the same risk, the demand maybe for the dollar denominated was so much greater than the local currency, and maybe you get paid to take on that risk. We're not going to make that determination. We're going to select managers, but we're only going to allow them to have that flexibility if we have the flexibility in policy. But we don't need it here, right? But it does allow a little bit of incremental flexibility, but that's the reasoning to support that.
Terry, doesn't it say the maximum shall be?
No, I just suddenly flashed it the wrong way.
I was gonna,
What?
I was just gonna say, I can see your point. I think it probably isn't worth pursuing, but what she's saying is when it says a maximum of 15% shall be held, it implies that some amount shall be held, but it shall not exceed 15%. Whereas if you said may, that would put a limit, or if you switched the maximum minimum around. But I think it's okay, because it's that way throughout the whole thing. And it is defined as a restriction as opposed to a mandatory.
My purchase is just the maximum,
Yeah,
as opposed to a max. When you say a maximum, it sounds like, well, we're gonna have something.
yeah, that's true.
And
So
we
just
need
the
to-
maximum. We can do it,
Yeah.
yeah.
So do you
There
want-
we go, now we're getting down to where,
Yeah,
now we're doing some board business.
The maximum,
You don't want that.
It's about time. 5 after 4.
I want to hear what Maggie has to say.
do you want those things?
stop.
Do you want that incorporated, so the maximum shall? I mean, those are just small.
I think you have it the right way.
Okay.
We just wanna make sure we're reading
No.
right.
I think we're good.
So, Mr. Joe, you, through your walkthrough, you think that was
One more.
Oh, one more?
On page 38, almost the last, the number 4 on page 38. Now that we've started investing in diversifying asset class, here is another one similar to what we took out on natural resources, because that is now at this point diversified across managers. That we're just saying to go from 1 to 2%. You know, I guess if I were consistent here, I'd say, well, just remove 4, because as we talked about under natural resources, but I recognize natural resources is still a new asset class, one we're getting comfortable with, and one we'll be talking about as we go through the year. So it was more of an incremental change, but you know, if I had my druthers, I'd say like natural resources with that, you know, I'd remove 4, but it's just proposing at this time to switch the 1 to a 2. And that is all the proposed changes.
Okay.
I don't know if there were questions.
Thinking about the
I think this has been a good exercise, but I don't want Joe to get the impression that all this is approved. I think you're there, but for instance, on this one, I would probably vote against that.
Okay.
And so,
Yours.
so anyway, I want to make sure procedurally, we have the ability to do that.
So we do, so that the helpful thing over time is to, if you have additional questions or you have directions you would like to have, like that is very specific, you know, how you would like to see it. You know, maybe Dan, you can give the direction here, but my suggestion, I know Dan's talking to you guys on a regular basis, but give that information to us and we will incorporate that in this next version, right? And if need be, if there's different views, we can provide, you know, some education and more discussion on it.
Well, does the course of the discussion we're going to have at our next meeting about
tie into this?
Yeah, well, I mean, that seems like to be the horse, and then this is the cart.
Or chicken and egg.
Well, yeah.
So
we'll figure it out.
I guess what I'd ask of the board is, this is going to be one of those issues that you're going to be very acutely aware and want to be deeply engaged in. The investment policy statements are yours.
Yes.
It is the delegated authority by which we operate under. So to the extent that the conversation we'll have, and as I'm calling it, discuss delegated authority, asset allocation, and asset deployment for May, which is, we have a very, very full May agenda already, and we've just enhanced that fairly substantially. To the extent you have feedback on what Joe has just presented, I'd ask you get that to me into one central repository so I can work with Joe and his staff on your behalf to have sort of a, what I'd like to do is have this broken into segregated motions for you at the next, because I don't see that there's going to be unanimous support for all of it. So sort of think of it as Brexit, our version of, we will have a series of indicative votes.
Hopefully we can make it so that it contradicts each other.
Yes. So to the extent that on these investment policy statements, you have individual components that you are concerned about, get those to me. I will work with Joe and his staff to address them on an individual by individual basis so that when we come back in May, we can have the asset deployment conversation, but then also have these prepared for you. That if there are some that are truly sort of cleanup and clarification, and you come to a consensus among that prior to the meeting, that can be one motion, but to the extent, like on page 38, the 1 to a 2, and there isn't, that we can have segregated out into a separate motion for you to consider.
Are we going, and I say this selfishly because I told you I'm not going to be here, but or is there a way, can we divide this up between May and August?
We can, well, what does,
I mean, do we need this? No, August is too.
Any of these proposed changes aren't critical to do in May. So we could, like, say if we heard from 3 board members, they'd just leave this last one at 1%, right, and didn't hear from other members, we would just leave it at 1%, right? And we would even propose that, right? But if you want to, I think we could have additional discussion in May, but there's no rush to approve it in May, right?
What's that, is August full term?
No, August looks like it has less than May does.
well, I think for us moving forward, to the extent we have to have an asset deployment conversation, that needs to come sooner rather than later. Right, that needs to be in May. So maybe we'll park this entire plan until August.
I think if there's discussion, I would have discussion such, because the more we can move down the path to educate, clarify these things, not look for a decision maybe until August.
Right.
Then I think that is good, but you know, the more we push it off, the more that's forgotten maybe from today, and so if we could.
Joe, we won't.
But I understand the prioritization, but I wouldn't want to put off questions or opinions until the August meeting.
Well, I think.
I wonder if we couldn't have our meeting in Italy with Carl.
Don't put that in the minutes.
Yes.
So, I mean, I think that the asset allocation broad.
In May.
Right.
Yep.
That might be, that is going to drive, to some extent, some of this.
Well, the asset allocation will drive the asset deployment, which we need sooner rather than later.
Right.
And then we can adjust, based on those 2 items, we can adjust the delegated authority, which you give us the investment policy statements.
But we don't need
the timeline is not ideal for all of it.
Well, I don't want to hold it up. I just think that's an awful lot of work to do, plus the regular meeting stuff in May, which is also our employee evaluation stuff. So we've got the first half of the day is busy.
On the May agenda, not to skip around, but it ties in to maybe freeing up time. We have state government customer relationships and state fund as a principal investment client on that agenda as well. Typically, we've invited 4 or 5 folks, in addition to the state fund principal clients, to come visit with the board. I almost wonder if that's something you could do over a working lunch as opposed to an agenda item. Have them for lunch. It's probably more conducive to better conversation. That'll free up some time on the agenda for you. The quarterly reports, again, to Joe's comments, and I think what we're getting some consensus of the board on is we're less interested in what has happened and spending less time on that and more interested in where do we want to go. So I think we can substantially shorten those. But again, understanding you want to hear from the staff in these respective areas on a regular basis.
Well, I don't. Is it unthinkable to have a little more time in May?
We'll fill.
I think you should have a 3. It would be my.
Gotta bring it up.
I mean, is the board?
Fine.
Is 3 too much?
Done deal.
I think 3 is too much.
No, I'm kidding. I wouldn't, I don't think, I think we have an obligation, a fiduciary obligation to get a full quarterly report.
Okay.
So I think when you're talking about some of these presentations that we have, that people may be spending more time reading to us from slides that we've read, we can speed those along. But I think it's our fiduciary obligation quarterly to get a full report on that.
Why don't we do this? Managers are meeting on, not next Monday, but the following Monday. Why don't we put together a draft agenda for May, including these items, get it to you and the vice chair, and just see if this kind of addresses the timelines. We'll circulate it amongst the board. I think the only way we'll be able to get to some resolution is if we just put it on paper and say we're going to dedicate this much time to these things.
Although I go ahead and send it to everybody.
I'll send it to everybody.
Does that make sense?
Yeah.
I apologize.
No, I think that's great. There's nothing in this policy or what we're talking about the asset class implementation. And we're making decisions for long-term purposes, right? And so to push that off for a meeting or 2, better for us to get it right, and have discussion and understanding. There's nothing critical nearer term. We believe RBK, shared their opinion. We think the portfolio is well positioned today, well diversified, and so there's not a sense of urgency to make any dramatic changes.
Okay. All right. Recap. We just covered the one thing.
We covered the one thing.
Agenda for May.
The agenda for May. We have just a quick update for everybody. I got a couple of questions from individual board members about the Colstrip bill, the Representative Hamilton referenced. Any application under the passage of that bill would still be subject to our due diligence and underwriting requirements. So even if the bill did pass, like the $10 million working capital loan of last session passed, they would still be subject to our internal due diligence and underwriting requirements.
But the amendment was added on the Senate floor, right, to say a preference shall be given.
So the preference shall be given to a Montana producer. So it's, as I read it, it doesn't do anything because a preference can only be given if you have 2 competing applications. So for instance, you have, the bill says a maximum of $50 million. You as a board have set an internal cap for staff of $30 million. So if someone comes in asking for a $50 million loan due to concentration risk, we probably wouldn't approve that. So the bill is, and I mean this with all due respect, the bill is written absence and understanding of how our underwriting and due diligence systems work.
So you don't think that language could be read as that a preference shall be given to a Montana producer over people seeking other intercap or infrastructure loans? My quick reading of that was I had reached the other conclusion. It was saying a preference for fossil.
476. The way that it's structured under, and you and I need to have a conversation about statutory construction. Because we both, the way I read it was for that specific type of loan authorized under that subsection of code is the preference is only for those coal-related loans, not interrelated with the other in-state loan programs. But you and I may have
Well, no, I just did a
different
quick reading,
reasons.
you've
Yeah.
been dealing with it, but all I was wanting assurance was that it didn't make a preference that overarched.
And the reason I say that is because during testimony, the 476, the sponsor mentioned that, well, this may be, what about an out-of-state coal company that wanted a loan to do business at that particular facility? And that's when they added the preference language, that it was a preference for Montana producers, not for, say, a Wyoming coal company who wanted to do business in Montana and sell Wyoming coal to a Montana utility firm. So but they may have drafted it wrong, which I would be shocked and amazed if that happened. Other than that, follow-up, delegated authority asset allocation, committee is formalized. I'll make sure everybody is aware of the scoring changes to the RFP. We'll get a formal timeline on that once the RFP is issued to the EMAC system. That was all I had. Anything I missed?
Doug got confirmation on what Mark was concerned about on that one loan.
Yeah, I'll make sure that the banks have the appropriate language that will address default provisions with
Quick
local
standard
laws.
documents, I don't think it covered this, so that was, all for us.
When considered a loan plus any interest.
Yeah, so that's just
Do you agree it's not a cost, which is what? 63 is right here. Oh, 6A.
Yeah, we shouldn't let the lawyers sit by each other.
Well, I think it's good.
Then, yeah, you and I had to read it.
Just wait till you get your bill.
Yeah.
What they should have, I think, is replace the
Right.
So the way I read it is this section of the
Nobody has comments or
Boy, I don't want to do that.
Are we done?
Are we?
Oh, that would be my chair.
What do you mean?
No.
You're the chairman.
Yes, thank you all very much.
Thank you for asking.
We were waiting with bated breath.